I think these higher interest rates are starting to bite on this economy.
Fundamental, technical elements have driven yields beyond where they probably should be.
We have to see more repricing of risk assets reflecting the higher rate environment.
As long as the real economy continues to grow, we can afford interest rates at this level.
Yields are rising because we're finally seeing supply come in and really scare those bond vigilantes.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It's the bond markets world. We just are living in it. Good morning, Jonathan Ferro, Tom Keene, Lisa Abramowicz. This is Bloomberg Surveillance. Good morning. John and Tom have ditched me this morning, but we are very much in luck because Manus Crenny and Gina Martin-Adams are both with us, which is a good and beautiful thing as we try to understand how we can get past a bond market that just won't let anything else matter. Manus, I wanted to talk about earnings. I wanted to talk about geopolitics. I wanted to talk about everything else. And instead, we're talking about a 19 basis point swing in the 10-year. Suddenly, boom, it hit the 5%, no thanks, and all of a sudden came crashing down.
So the question you need to ask yourself was, Bill and Bill's terrible adventure that came to an end, Bill Ackman and Bill Gross, do they really have that much swag in the bond market? I don't think so.
How long did it take you to come up with that?
Danny and I came up. We've been here since 2:30 this morning.
All right, carry on.
The bottom line is, you're right, that huge amount of volatility in the bond market. The one thing that surprised me was, why did the equity market not get more of a bid on the back of such a swaggery move? Was that just steepeners being taken off, or was it reappraisal of bond risk?
Yeah, and probably it's just PTSD in the equity market. I mean, the last month and a half has been absolutely terrorist impacting the equity market from the bond market, and there's just nowhere to turn. High beta stocks, low beta stocks, there's no defensive strategy in the equity market when the bond market is moving this quickly, because the defensive stocks tend to be more bond sensitive. They tend to be more debt ridden. And the result is the equity investor just doesn't know where to turn. And so I think that, frankly, one day is one day, and the equity market is going to say, okay, wait, let's see where the trend moves from
Hold on
here.
a second. Let's just put a bow on that, because are you saying that basically we are seeing the stock market have more rationality and a little bit more control and less volatility than the bond market, which is thought of as the smarter of the two asset classes?
Yeah, well, and this has actually been the story all year, bond market volatility far surpassing equity market volatility, where equities do have another thing to hang their hat on, right? And that's called earnings and broader economic conditions. And earnings have generally started to improve this year relative to where we were last year. So equity markets can trade on that as well. The bond market definitely impacts equity market valuations. It impacts high debt stocks in the equity market, high leverage stocks in the equity market, but not the market at large. And so the equity market volatility can remain relatively suppressed even when bond market volatility is so extraordinary, considering the earnings backdrop.
It's pretty shocking to me, especially as we wait for earnings from the big tech names, including what we're going to get today from Alphabet as well as from Microsoft. When we take a look at Davos to the desert, and I know that you have intimacy with this, Menace, based on your time in the Middle East, in Riyadh, at this FII conference, pretty dire commentary from some of the CEOs there. It was sort of surprising to me that suddenly they're striking a note that is really pessimistic.
Well, it shifts every time you hear from, what was it, a couple of weeks ago, Jamie Dimon was talking about the possibility of 6% on Treasury yields, maybe even higher. But it's interesting, when you go through the roll call of who's there, you can find the bond trader and the CEO. The bond trader is, of course, Ray Dalio, from the bond market, Ray Dalio, who says he's more pessimistic on the outlook for the global economy. Then you look at Noel Quinn, and he's saying we're at a tipping point on fiscal deficits. So again, they're all incrementally becoming more bearish on their outlook and their guidance.
Well, and this raises a question, and the State Street CEO is talking about the hangover that the market seems to have, the suppression from the geopolitical transpirations, events. How much do you see that we definitely are seeing a damper put on equity valuations because of what's going on? Over in Israel?
I think you see it mostly because of what's happening with yields, but oil prices are the proxy for what's happening in the Middle East as far as the equity market is concerned. And when oil prices started accelerating in July, August, September, it definitely had an impact on the equity market through rotation. It had an impact on sector performance as well as country performance globally, and it's starting to show up in earnings numbers as well. So the oil users of the world are seeing earnings revision momentum turn sour, where where the oil producers of the world are generally experiencing a positive lift.
When it comes to oil, we are seeing a little bit of a lift this morning, a little bit of a pop in West Texas Intermediate, also in crude. Some people looking at this as a gauge of what's going on in the Middle East, and yet hard to really get any kind of read. 10-year yields, this is where all of the drama is, 4.846% after climbing through 5% at one point, peak to trough yesterday, 19 basis point swing in the 10-year, a 21 basis point swing in the 30-year yields, and a bit of euro softness because of some data that we got out of Europe. Possibly pointing to a recession there. S&P futures up 0.5%. What we're looking at today, just talking about the recessionary conditions that potentially are coming to the fore in Europe. In the U.S., 9:45 a.m., U.S. S&P Global Composite data comes out. Does they get a confirmation of the same kind of weakness in the U.S.? I know, Gina, you've got a lot to say on what we're seeing over in Europe today. The Future Investment Initiative Conference in Riyadh has been starting. The Davos in the Desert, 7:10 a.m. Don't miss this. Jamie Dimon of J.P. Morgan will be joining our own David Rubenstein. I say our own, but he's the co-founder of Carlyle, also the host of Peer-to-Peer Conversations. And today, Alphabet and Microsoft reporting earnings after the bell, really key to understanding just how much more this equity market can rally, given what a momentum builder these two have been. 55% gain for Google shares, Microsoft shares up 37%. Joining us from Salt Lake City, he is not skiing. There is no snow. He is not hiking. He is just there for the casual conference. John Stolfus, Chief Investment Strategist at Oppenheimer Asset Management without a tie. It is lucky that John and Tom are not with us. John, how do you get away from the volatility in the bond market?
Well, I don't think you do. I think what you do is you've got to get through it, Lisa. At these times, what we're primarily recommending to our investors in times like these, when the bond market sets the stock market bouncing between gains and losses, look for babies that get thrown out with the bathwater. Think of your goal as being beyond. It is not in the day. Distinguish yourself between a trader and an intermediate to long-term investor. And there's plenty of opportunity here.
John, good morning to you. The biggest opportunity, I mean, we've had a couple of guests yesterday come on the show and say now is the time perhaps to move neutral on duration. That was BlackRock. Now is the time to think about adding duration. Do you feel more comfortable adding sovereign duration than you do corporate duration?
Well, actually, we have a mixed view of that. At the longer duration, we think more corporate. And at the shorter end, we think, of course, we think of the govies at this particular point. We are overweight equities, underweight fixed income. But we do think in this environment, the good news is it's the end of free money. It's a normalization of interest rates. Bond buyers are getting something in return for the money when they buy a bond, and bond issuers have to pay for the privilege of borrowing money again. We're leaving a period of emergency liquidity to a more normal environment, but it's difficult because it's a dramatic increase in interest rates on a nominal basis. And it's costly for leveraged investors, but that's not our venue.
I'm going to leave the conversation to Gina on the terrorism that has been sort of wreaked by the bond market on the equity market. But when you look at this structure of the market that happened yesterday, what happened yesterday was virulent by anybody's estimation. Mohamed El-Erian has made the point on a number of occasions about the short-term stabilizers and the long-term stabilizers of the bond market perhaps have been dislodged. Yesterday's market performance, how alarming was that to you in terms of the kind of moves? What was it? It was the long end moved by 19 basis points, 30 years down 21 basis points, my apologies, and 10 years down by 19 basis points. Was that stabilizers being removed or Manus, don't worry, that's just a little bit of catharsis?
Manus, I've been in this business for 40 years, so I've been through every boom, bust, and recovery cycle since 1983. And when we see this kind of a thing, the one thing it seems very clear to us is this is not atypical to see these kind of moves, dramatic moves, okay, not specific moves that were yesterday, but with all the things that are going on within the market and globally across asset classes. It is to be taken into consideration, actually is quite normal. We're right about where we should be in the process of this. It's uncomfortable, but considering where we've been from the financial crisis to the pandemic, to the disruptions of the supply chains, and now to a geopolitical risk that is elevated to an extent that we haven't seen in years, this is not atypical.
John, one of the things that has changed over the last few years is this degree of bond market volatility, which is abnormally high compared to equity market volatility. Do you anticipate that to change going into 2024? And how does that volatility differential really frame your equity market outlook?
Yeah, Gina, I would have to say, when we look at this year, we came in overweight equities, underweight fixed income. In terms of performance, it hasn't really been a bad call if you look at the S&P 500 versus the Bloomberg, Global Treasury Ag. It would seem to be way to go equities. We would expect that going forward, we'll experience less volatility as the Federal Reserve is able to exhibit the fact that its operations, working its mandate with amazing sensitivity, this particular hike cycle, in my experience, I'm amazed, they're being helped out by the long end of the bond market, where we've seen yields come up. This looks like just a process that is not comfortable, but is one that should reward investors who are diversified and understand their objectives and can sustain a certain amount of volatility. Although if you consider the volatility that we've experienced at different periods over the last 40 years, I mean, it's just this is a transitional period, and transitions aren't easy.
And then with your overweight on equities, I would imagine it's been a relatively frustrating period given the lack of breadth and participation in the market from small caps as well as the top 7 S&P 500. What do you think is going to catalyze better breadth, better performance, more distribution of gains across the equity market?
Well, I think some of it will probably be from a structural perspective. If you look at it, in the case of some sectors, you'll find better valuations in other areas. But the area of technology is likely to be central to all of this. And the fact that technology today is in a period of innovation in which what it's doing is not just for technology. It affects the consumer and business. It's deeply embedded in the lives of business and the consumer. And advances in technology affect all sectors, all 11 sectors of the S&P 500. This year, if you do a year-to-date SPXL1 on a Bloomberg GRR, you'll bring it up and you'll see that on a year-to-date basis, it's the cyclicals that have beaten the defensives. Mm-hmm. Extraordinary. And, consumer discretionary, communication services, and I'm looking at my Bloomberg right here. It's like an eye test at this hour of the morning. But in industrial, I mean, really haven't done all that badly if you look at it. And in terms of earnings seasons, we've seen earnings seasons that have once again outpaced expectations. It's not a robust situation, but it's consistent improving resilience. And that's what we've got to see. That's got to continue. But it's a lot of factors that are working here, whether among the consumer, whether it's business, whether it's the Fed, whether it's the size of the U.S. economy and its diversity. It's been a remarkable story so far. 4,900 still your target by year end, John? It remains at this point 4,900. We would have to say when we put the 4,900, we had our target that we put in last December was 4,400. It was realized sometime in June or July, as I recall, when the market closed above 4,400. We gave it a couple of weeks. We saw what was going on in the market. We raised our target to 4,900, looking for about 6 to 7% upside. From that level, last I looked, it's around 12 or 13% we need to get. It's under observation, but at this point, we're going to we'll leave it at 4,900 for today.
John Stoltzfus, thanks so much. Tylus in Salt Lake City, and you passed your eye test. Thank you. John Stoltzfus of Oppenheimer Asset Management. Really interesting to see, sort of clinging to the bullishness despite a whole host of tyranny by the bond market. Interesting.
Yeah, and his commentary around defensive sectors, I think, is really telling. It's something we're exploring as well this week, is this dichotomy between really low breadth, very poor performance, and yet defensive sectors generally performing the worst of the S&P 500 is quite unique.
Coming up next hour, we've got JP Morgan's Jamie Dimon. Right now, we're taking a look at some gains.
earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
We're making bank. And I think that is what we could take away.
Bloomberg Television and Radio. Context changes everything.
I look at the financial situation, the fiscal spending, which is more than it's ever. I'm talking about the United States, but it's almost true around the world. It's more than it's ever been in peacetime, by a long shot, with the highest debt levels we've ever had by government. And there's this kind of omnipotent feeling that central banks and governments can manage through all this stuff. I'm cautious. I don't think it makes a piece of difference whether rates go up 25 basis points or more. Like zero, none, nada. I think whether the whole curve goes up 100 basis points, I urge people, be prepared for it. I don't know if it's going to happen.
Tell us how you really feel and what are you running for? That would be Jamie Dimon, JP Morgan Chase CEO at the Future Investment Initiative in Riyadh, Saudi Arabia. We will be hearing more from him coming up in about an hour when he speaks with David Rubenstein, host to Peer-to-Peer Conversations, as well as co-founder of Carlyle. Right now, we are struggling to understand some of the geopolitical developments, especially in light of markets that have been relatively sanguine. Yes, you could see crude traded on the NYMEX up about 0.5%, $85.98, but still subdued kinds of price action at a time where there's some pretty fiery rhetoric and there's some pretty concerning discussion about the U.S. losing its role on the global stage. Joining us now to talk about this, Jennifer Flitton, head of U.S. government affairs at Invesco. And Jennifer, I want to start there. We're starting to hear more about the myriad conflicts that the U.S. finds itself facing and the inability for a fractured government to deal with it. How concerning is this to you?
I think the fact that we don't have a speaker of the House right now is very concerning. I think it's concerning the Republican conference right now, who is meeting at 9 a.m. this morning to decide among 8 members now who will be their next speaker. And I don't think they're anywhere closer to 217 than we were 2 weeks ago, which is the magic number to get a speaker on the House floor. And with the volatility in the Middle East, in Ukraine and in Indo-Pacific, this is really the focus right now that the Senate's about to take on in a supplemental bill that the president had sent to the Senate last week.
Good morning, Jennifer. Good to talk to you. So every time we show this montage of faces of who could lead, what goes through my mind is how do we go from a field of 2-3 last week to a field of 9? But what I want to know is for any of these newcomers to shine and actually have a fighting chance at getting it, what do they need to do? What do they need to say? What do they need to convince the GOP of?
Well, I think right now it's about bringing the different factions together of the GOP in the House, because you have the conservative hardliners who really want to stick to the previous year's fiscal level in the appropriations bills, right, in the government funding, which has to be done in some way. We either have to pass a stopgap resolution on November 17th to take us into the rest of the year, or they have to come to some sort of agreement on appropriations bills. And right now, the Senate is marking to a different fiscal year than what the House wants to mark to. And then you have to bring in your moderates, right? I mean, those who are concerned about pragmatically governing the House. And so bringing those two factions together is going to be the biggest mountain to climb for whoever is coming into this job next.
Now, the front runner in your mind, and correct me if I'm wrong, is Tom Emmer. From a market perspective, from a risk perspective for us on the other side of the fence in markets and money, is that the kind of name that delivers continuity, constructive government, and deliverance in 2024 going into an election year? Is that the kind of name that you're coalescing around that is good for markets?
I think the short answer is yes. He is a member of leadership. He is the current majority whip. He has actually executed on getting legislation passed, and he understands his conference. And so having someone at the helm like Tom Emmer would be a positive sign, I think, from our perspective.
Jennifer, what timeline are we looking at for the next potential government shutdown, and how does this lack of sort of speaker impact that potential shutdown timeline?
So we're looking at November 17th. I think it's very difficult to see a scenario where the House and Senate comes together on an agreement on how to fund the government going forward prior to November 17th, because the House is just in such disarray. So we will likely have to see some sort of stopgap resolution passed by November 17th. I think the question right now in seeing where the Republican conference is with regard to electing a new speaker is, what is the forcing mechanism? Is it that November 17th deadline, or is it a supplemental bill for Israel or for the rest of Ukraine and Indo-Pacific and the border security? What is that forcing mechanism? I think everything sort of revolves around that November 17th deadline right now.
And then when you think about all of this uncertainty coming out of Washington and, frankly, geopolitical uncertainty across the world, what do you think? How does this manifest in financial markets? Do you see this sort of purely as elevating risk premiums? Do we see this play out in commodities? Where do you see the most profound trade to emerge over the course of the next 6 months?
Right. And we're also in earnings seasons right now. I mean, it's difficult to know how this is going to play out. And keep in mind, we're all in Washington sitting on the edge of our seats, waiting to see what comes next in the Middle East. It's hard to see how that doesn't take a predominant place in making decisions going forward for Washington. And I would assume the markets will have a reaction as well.
Jennifer, I was reading a column by the Axios CEO and one of the co-founders, and it started as such. Never before have we talked to so many top government officials who in private are so worried about so many overseas conflicts at once. And it talked about how there are only so many people in the room, and they're grappling with just a growing number of potential risks, whether it's what's happening in the Middle East and Iranian-backed proxy fighters, whether it's China and possibly buddying up with Russia at a time to exploit U.S. weakness, whether it's the fact that the U.S. can't get its own House of Representatives together. How do you sort of view the confluence of all of these things and how it will direct the U.S.'s response and ability to respond this time around?
Well, and I think in that same Axios report, they were talking about the fact that the White House is actively getting intelligence reporting to House members, to the Big Eight, but also to the rest of the conference and the caucus in a bipartisan way to get those members, those senators up to speed on the confluence of those factors and what it means geopolitically. I really think that over the next 3 to 4 weeks, there are going to be so many shifting dynamics internationally and potentially domestically that is going to force the hand of the Republicans in the House to really get it together and move forward with a speaker, whether that is one of these 8, whether it's another member, or whether it's empowering the current Speaker pro tem.
Well, we'll all be watching. Jennifer Lipflitten, thank you so much of Invesco for the insight. Hopefully we can catch up with you again soon as we try to make sense of all of this. Gina, I've got to say, how do you price in something like this, sort of an existential risk to equities, but just broadly, just sort of what America's role is in the world?
It's very difficult because ultimately the greater degree of war, the greater degree of geopolitical conflict you tend to see that as an inflationary aspect. You tend to see that as a growth sort of stimulating inflationary ultimate outcome. Yet at the same time, we have no certainty that we're actually going to participate considering what's happening in Washington. We don't know what the path for spending looks like, even for domestic spending, let alone geopolitical sort of support. So the uncertainty is tremendous. I think the only real play in the equity market is through rising equity risk premium, which we have seen as a result of the fact that the 10-year Treasury is moving so much. But you have to wonder how much of the bond market weakness is also related to these concerns. We, sort of think about it as purely monetary policy dynamics, and the components of supply and demand can be driven by a lot more than just monetary policy.
It's interesting when we say, to what extent are bonds a hedge? Are they suddenly doing what they were supposed to do in terms of grave risk? In actual fact, if you look at gold, if you look at Swiss, they have outperformed up until now, up until close of business yesterday. I'll get a load of IBs. They were the much more defensive kind of hedge. And we were slapped when we said that treasuries were a hedge. So it was Swiss and gold. Maybe that's pivoted. Maybe that's changed.
Coming up, Fadi Birol of the IEA talking about the oil complex. Another day, what will the market bring? And when I say the market, I'm talking about the bond market because that's all that seems to matter these days. John Ferro and Tom Keene are off today. I am very lucky to be joined by Menace Cranny and Gina Martin-Adams alongside me as we take a look at a market trying to bounce on the heels of maybe a little bit of a bond rally yesterday, but not today. And this, as the session grows older, just shows volatility is just the name of the game when it comes to the bond market. 10-year yields up just a touch, 4.85%, basically stagnant relative to where we have seen S&P futures up 0.4%. Menace, how many of the guests this morning were really just trying to understand why we have seen such incredible volatility?
I think you can throw any reason at this. You know, it's interesting. Jamie Dimon, the last clip that we played from Jamie Dimon was, does it matter if we get another rate hike? No, absolutely not bothered. But you could be prepared for another 100 basis points of steepener, which is not what happened in the market yesterday. There was a sense of exhaustion of the steepeners yesterday. There was a sense of exhaustion having tried to punch it up. And it just became a little bit exhausted.
Yeah, exhausting is the name of the game, and a lot of stock pickers are trying to figure out when they can start caring about earnings again. General Motors just coming out with third quarter adjusted earnings per share at $2.28 versus the estimate of $1.84. When can we care about earnings again, Gina? And that's really a key question.
I think it all comes down to the bond market, frankly. We've got to have some stability in the bond market before the equity market can calm down. I mean, this has been a really interesting earnings season because we've had about 75% of companies beat expectations. That's above the long-term average beat rate. You're still beating the long-term forecast. Analysts generally are still a little too pessimistic. So that tends to be an environment that's pretty supportive of equities. And yet price reactions, even for beats, have been way below average. There's just no upside off of earnings emerging yet. And I think that's because of the bond market.
We're going to be catching up with Paul Jacobson of GM later this morning in about an hour, a little bit more than that, to try to parse through the positives of the earnings plus what we've seen in the striking situation as well as with labor negotiations. Under surveillance this morning over in the Middle East, Hamas releasing 2 more hostages. Calls growing for Israel to rethink the scope of a ground invasion of Gaza. French President Emmanuel Macron is the latest world leader to visit Israel. He's meeting with Prime Minister Benjamin Netanyahu, where he's expected to call for the resumption of a peace process between Israel and the Palestinians. It is hard to get your hands around some of the negotiations behind the scenes, but Menace, to me what stood out was just that the ground operation seems to be delayed for a longer period of time, and it's due to pressure internationally.
Yeah, and that pressure is mounting. Macron is just, the Greeks were coming, the Dutch were coming, the French are there today. Now, will he build the narrative for ceasefire? And this was one of the, if I can use the word criticism, it was one of the aspects which came from the gathering of the Arab nations in Egypt over the weekend, that the coalition of the West had not been calling strongly or loudly enough for a cessation and a ceasefire. So let's see what the Macron narrative is today on the ground.
And Jennifer Flitton definitely highlighting all of us, and as we watch everything that it transpires overnight, every single morning and afternoon. Meanwhile, fresh data suggesting that the European region may be in recession ahead of the ECB's rate decision on Thursday. Composite PMIs coming in at a 3-year low, comfortably under that 50 mark that separates expansion and contraction. Meanwhile, Barclays planning to cut costs after its trading division missed estimates in the third quarter. The UK bank reporting fixed income, currency and commodity trading declining 26% from a year ago. Banks are at one side, especially after the U.S. Banks really showed that beat. But Gina, what you're seeing in Europe is not unexpected, right?
No, it's not terribly unexpected, especially with respect to the PMIs. Europe has been the weak player on the global stage now for several consecutive months. This really started to emerge this summer. I think in the banks, it's very interesting within the European banks. All the banks that had reported prior to Barclays had beat expectations. So when there's a divergence occurring between the continental European banks and the banks in the UK, the banks in the UK experiencing something very similar to the banks in the US, which is all about deposit flight, movement into money market accounts. The European banks have this sort of inherent stability, better net interest margins as a result of that lack of flight into money markets happening in continental Europe. And so that's a source of stability amidst all of the PMI weakness. At least the banking sector does seem seem to be somewhat resilient.
Well, I'm not exactly down on my own, either in Ireland or in the UK, but the level of sophistication that you have, or the access to movement of money very quickly, very easily. You walk down any high street, you don't have high streets, any avenue in New York, and you're able to immediately pull up an app and transfer the money into any house for, an ETF. It's much easier here and much more part of the zeitgeist to move your money around. Barclays underperformed, and they underperformed not just to estimates, but they underperformed relative to the US. There's only one sort of vainglorious banker in Europe at the moment. Guess who that is? Andre Orchel. I mean, he must just be sitting back going, that was a good move.
I'm sure
I left Sergio on the Hollywood team behind.
Well, maybe he'll go shopping, because it seems like that's what a lot of people are doing. Hermes sales jumping as shoppers in the U.S. and Europe splurged on the company's pricey Birkin bags. The luxury French brand saw third quarter revenue rise around 16%, beating analyst estimates. And this comes after LVMH disappointed. How does this challenge the narrative, Gina, that we are seeing a pullback by spenders at the top end, which was basically what everyone was saying with LVMH?
Yeah, so one key difference, I was speaking with my European equity strategist, Laurent Douillet, this morning about this, about the difference between LVMH and Hermes, and why is Hermes so much more stable? And he said, well, remember, LVMH has a wine and spirits business, and that was actually the source of weakness in the quarter. We sort of forget the diversity of these organizations, whereas Hermes pure luxury, clearly best in class, still doing generally fine. Some disappointments, but generally fine. LVMH had that drag from wine and spirits. So I think the story is a bit deeper than sort of just, oh, luxury, are they or aren't they? I think it's actually about product mix and the mix of within the companies themselves, sort of some key differences. But Hermes still clearly the leader.
All I can say is I'm personally deferential to Prosecco over champagne. I'm just saying, so I understand why that might have been a drag. This is really going to be one of the most important conversations of the day, and it really comes as everyone looks at the crude price to understand the geopolitics and what the risks are that are percolating on any given day. The International Energy Agency was created 50 years ago in the wake of price spikes and all sorts of geopolitical violence. Today, we're facing a similar type of moment. Joining us right now, Fadi Birol, Executive Director of the IEA. And Fadi, I want to start there. Even as you put out your report, which has a lot of really interesting projections, how is today similar to 1974?
Thank you. I mean, the main similarity is once again a major geopolitical crisis in Middle East, and once again oil markets risk to provide a major shock with a high and volatile oil prices. Oil security is at risk, as about 1/3 of the global oil exports come from that region, especially for Asia. So there are some similarities between now and 50 years ago.
Fatih, good morning. Every time that there is a moment of real angst, and we are at the moment of war here, so it's not just angst, it's war between Hamas and Israel. The question is the boundaries, the risk to Iranian crude moving, the risk to the rest of the Persian Gulf from this Israel-Gaza crisis. How do you look at that right now, and what is the risk of major escalation in your view, and the risk to the oil market?
So if one or more major oil producing or exporting countries are involved in this crisis, we have all the reasons to expect that the prices will go up, not only in terms of production, export, supply cuts, but there is a major strait, the Strait of Hormuz, which is responsible about 1/3 of the global oil transit and a major part of the global LNG, natural gas transit. We may well see substantial impacts on the oil and natural gas markets. Of course, we don't know, at least I don't know, how the geopolitical developments will go in the next days or the weeks to come, but the risk is rather high for the energy markets.
One of the narratives that is out there at the moment is that obviously you still have unilateral cuts from Saudi Arabia and from Russia. Novak has made it clear it's too soon to talk about what they would do in November. If there is a significant escalation, is that step one of an immediate release valve to the market of where Saudi and Russia may well put out some narrative in regards to their unilateral cuts or indeed act before the November meeting?
Yeah, it's a good point. In fact, when we look at the situation today, even before the crisis, this geopolitical crisis started, we had oil prices around $90. Very, very high prices compared to averages. Why we have it? For two reasons. One, global oil demand is strong, mainly as a result of the rebound in the Chinese economy after the COVID. But second, the point you mentioned, Saudi Arabia and Russia deliberately cut their oil production. And since beginning of this year, the International Energy Agency, we said, if you go in that direction, we may well see tightened oil markets, which could be a major problem for the global economy and for inflation, especially for emerging and developing countries. Now, this crisis comes on top of the $90 oil prices. And the one, of course, plausible scenario here, if we see such a crisis and if we see a deepening of this crisis as a result of some other countries being part of this geopolitical crisis there, then one possible option is the Saudi Arabia and Russia would change their production policies, and they have ample amount of spare production capacity. Okay. They comfort the markets there.
Can we zoom out a little bit and talk about your long-term views on what's going to happen in the energy complex? I mean, we've got this great World Energy Outlook report out today from your organization talking about, in the long term, global fossil fuel demand will peak by 2030 as we see the transition occur. Does that presume that the geopolitical tensions ease? What are the presumptions behind that peak forecast by 2030?
Now, we are an energy organization. We cannot focus what happened on geopolitical context, but the reason that we see, for example, oil, we talk about oil demand to peak in the next 5 or 6 years is the following. There is a big move on the transportation sector, which is a big chunk of the global oil consumption. Electric cars. This is when you look at the electric cars, 2 years ago, 1 out of 25 cars sold in the world was electric. 1 out of 25 2 years ago. This year, 1 out of 5 cars sold is electric. And in 2030, with the current investment plans, current policies, every second car sold will be an electric car in 2030. This is one. On the consumption side, it will be weaker. The second and most important one, and I'm a bit surprised that the analysts don't see this, China. China changed the energy markets in the last 10 years, and China is changing itself now. When you look at the last 10 years, more than 2/3 of the global oil demand growth came from China only, more than 2/3. And Chinese economy increased over 6% per year on average, and this was the main driver. And we all know, it's a consensus view, including the Chinese government, Chinese economy will slow down, and this will be another driver for the global oil demand peak
Fatih,
in the next years to come.
Fatih, I only have a minute left, but this is a really important point. Are you saying that even if China has an economic boom, it is not going to increase some of the demand for oil based on the changes in that economy?
I mean, China may have a growth in their economy as a result of stimulus a year or so, but the structure, Chinese economy, when you look at the structural, the balances in the Chinese economy, the cement production, the iron steel production, the household stocks, they all come to a saturation or a decline. China wouldn't need major amount of energy, so China will be determining the next years the fate of fossil fuels, and also at the same time, of course, clean energy, as they are a champion there as well.
Fatih Birol of the International Energy Agency, thank you so much for taking the time at a pivotal moment. We're all watching the price of oil to get a gauge on just how potentially wide the conflict could spread in the Middle East. Coming up, Jennifer Johnson, President and CEO of Franklin Templeton. We also will be speaking with the former Prime Minister of Jordan. This is Bloomberg.
Long term, I'm certainly optimistic, but I'm uncertain right now. And if you're a CEO and you're uncertain, you tend to be cautious about doing significant things that change the trajectory of your business.
All of the CEOs in Davos of the desert. That was David Solomon, Goldman Sachs CEO at the Future Investment Initiative in Riyadh. Right now in markets, you can see yields just trying to hold on to a bit of a decline, but not succeeding. 10-year yields 4.85%. S&P futures holding on to gains up 0.5%, and euro softness after PMI data that showed potentially 2 straight quarters of recession or 2 straight quarters of contraction. Right now, I don't want to delay a great conversation coming up. Bloomberg's own Youssef Gamal Al-Din is joining us, sitting by with Jennifer Johnson, President and CEO of Franklin Templeton in Riyadh. Let's head over. Youssef, hey.
Hey, Lisa. Yeah, so let's pick up on the big debate on the health of the U.S. economy and a few other angles as well. Jenny, thank you for making the time. So we had Jamie Dimon come out strong. He's saying there should be a lot more humility from central banks. They got all their forecasts wrong. Ray Dalio is pessimistic. I want to know where Jenny Johnson stands in this debate.
Well, I mean, I am a little concerned about U.S. debt and its impact on interest rates, right? I mean, I think that the conversation on rates is constantly focused on what Powell's going to do next month or December. And I actually think the bigger story is really around, we've got a U.S. debt that has gone from $9 trillion to $31 trillion. And you have to have buyers of that debt. And that means you have to have a rate that's reasonably priced to attract debt. And it potentially crowds out some of the other investment opportunities. So, that's a concern. And you've got a deficit this year that's going to add $2 trillion to the debt. So I think that can weigh on the economy.
And where do you see interest rates going then? I mean, 2 weeks ago, you still had the view that there's one more hike in the plan. Do you still stand by that?
I think Powell kind of came out and said probably won't do it in November, but he's watching the data. So I think, maybe he'll do December. I think it'll be data driven. Maybe he'll just kind of leave it for where it is and see how it plays out. I think the bigger story has been around the 10-year, and I think that's more of an issue around the U.S. debt.
I mean, you've seen the volatility in Treasury yields, and of course some of the prolific commentators, let me put it that way, including Mr. Ackman and many others. Do you think that we're going to start consolidating now at the current levels? I mean, what's going to bring them down? Because there was a big debate on what's going to carry them up. If they are going to go down from here, what's going to push them down?
I mean, honestly, there's a lot of things. I think that the Fed has done a good job on kind of jamming on the brakes and raising rates and slowing things. But there's tremendous headwinds to slowing inflation. Oil prices are inflationary. Some of the union wage negotiations are inflationary. So there's factors that makes it tough. The spending on things like renewable energy, government spending and incentives on renewable energy and things like the CHIPS Act are all pumping money into the system. That becomes a headwind to somebody who's trying to tamp down inflation.
One of the stories that's been trending in the last 24 hours on the terminal is about $600 billion worth of client cash, that it's headed for the exits from some of the bigger investment funds. And it raises the question, how does Franklin sort of thrive amid a shift to more passive solutions?
Well, first of all, let me take on that.
Are you going to push this back?
I'm going to push back on the passive active.
Okay.
Right? Anytime you have a full momentum market where you've literally had central banks printing money, right, and interest rate zero, the only place to go was the equity markets. That pumped the equity markets up. But today, right, and first of all, nobody ever talks about market beta or passive as going up or down in risk. The day Tesla was added to the S&P 500, market beta became more risky, right? And we don't talk about that. Now you're sitting here today, you've got a market where you look at it and say it's up 13%, but actually most of that's because of 7 stocks, the Magnificent Seven. You're seeing the highest concentration. At the peak of the dot-com, 10 stocks accounted for 25% of the market cap. Today, that's 30%. So, or 32%, right? So you're even higher from a concentration. It usually doesn't end well after that. And from the return standpoint, top 5 stocks have a PE ratio of 49, and the rest of the market has a PE ratio of like 14. So, those are really different from a risk scenario. Now you got to navigate interest rates. You got to figure out the impact of rates on different companies. I think it's a time for active management.
That warrants its own debate. I want to get to your meetings here in Saudi Arabia. Talk to me about the opportunity set here and where you could sort of lock in additional growth.
Yeah, so, I'm here at FII, and, one of the reasons to be here is because Franklin Templeton's a global company. We have clients in 160 countries. You come to FII, you can meet your clients from Asia, from the U.S., from Europe, from all Africa, all over the world. And so it's a great place to convene and efficiently meet with clients. But it's also, I tend to think energy transition, a lot of the innovation is coming out of this region. And I know that sort of sounds counterintuitive, but what you find is a mentality of multiple generations, thinking about how do we position ourselves for generations, and a recognition that at some point oil goes away, we better diversify the economy. And you see initiatives in Saudi Arabia where by 2030 they want 50% of their energy coming from renewables. UAE, I think, has said by 2050 they want 50%. Yeah. This is a region that has the will and the capital to actually focus on that innovation.
We're closely monitoring what's happening with the Israel-Gaza conflict. It's a human tragedy in the first instance. In terms of sort of second-round effects, capital markets, to what extent is that going to take away from some of the ambitions that the Gulf has as an investment destination, longer term?
Well, first of all, it's an absolute humanitarian crisis. It is a terrible, terrible situation. It's very difficult to watch it unfold, and it's awful. If it stays contained, it probably won't have longer-term impacts other than in obviously tremendous impacts in the areas in both Israel and Gaza. But as long as it remains, contained, then I think it doesn't slow things down. And honestly, I think, places like Saudi and the UAE are actually motivated to try to come up with a resolution because they don't want to derail the progress that they're making on their visions, and trying to attract capital into the region.
So closing question on broader strategy. You've been acquisitive. What's sort of next on the purchase list? How much are you willing to allocate?
Well, we've been very open about the fact that we think sort of the last area that we'd love to fill is infrastructure. I think the spending on infrastructure, whether it's energy transition or even just updating infrastructure, across the globe, because so many of the developed markets have aged infrastructure, is a great opportunity. So that would probably be the last area that we feel we need to complete sort of our product capabilities.
Jenny, great to touch base. Thank you very much. Best
of
luck with your meetings over the next couple of days. It's Jenny Johnson, the CEO of Franklin Templeton. Lisa.
Thank you so much, Yusuf. Great interview. And honestly, really interesting to hear her talk about how it really is the budget deficit above all else that is causing yields to whipsaw. Gina, you were saying earlier that, all of a sudden this is underscoring the idea that maybe this isn't a haven in the way that it has been in the past.
Yeah, and it's very confusing for the equity market, which is already in a confused state with respect to bonds. Let's not forget the fact that correlations between stocks and bonds have completely flipped into bizarre territory over the last 3 years. The correlation is in completely alternative territory relative to where it was for the last 20. So we're more sensitive to movements in bond yields. The directionality of yields is important, but the volatility is also incredibly important for the equity market underpinnings. And to have this kind of uncertainty from a geopolitical perspective as well as from a just general operational perspective from the U.S. government creates a lot of uncertainty for the equity market that you wouldn't have normally considered this. But nonetheless, the two asset prices are very closely correlated and our fates are tied.
The structure of this bond market, and this is the point that we touched on yesterday, has irrevocably changed. We're in an era of QT, no longer QE. We're in an era where banks are perhaps a little bit more judicious about what they want to do, how much they want to hold in the hold to maturity bucket. So the natural go-to buyers of this paper that needed to be printed for the fiscal needs is very, very different. And Jamie Dimon, just to punch it again, he said he doesn't care about the next hike. But what he does care about, and he referred to, is the potential for more steepeners to come back and bite us, which goes back to his narrative, I know, from a couple of weeks ago.
But he's not wrong. When I talk to people, they say you can focus on whether you're going to get another 25 basis point rate hike. But if you're really looking for things to talk about, there probably is something better that you can spend your time doing. Gina Martin Adams of Bloomberg, unfortunately, We're running out of time. Do this again because we love having you on. So
My
great
pleasure.
to have
Thank you
your
for having
wisdom. Menace, you're not going anywhere, sorry. But coming up, we're going to be hearing from JP Morgan's Jamie Dimon himself. Maybe he will continue to be fiery, maybe give a prescription and maybe run for something, because that has always been the speculation, joining Carlyle co-founder David Rubenstein. We also have some fabulous conversations, including the CFO of General Motors at a time of strikes and higher labor costs. From New York, this is Bloomberg.
I think these higher interest rates are starting to bite on this economy.
Fundamental technical elements have driven yields beyond where they probably should be.
We have to see more repricing of risk assets reflecting the higher rate environment.
As long as the real economy continues to grow, we can afford interest rates at this level.
Yields are rising because we're finally seeing supply come in and really scare those bond vigilantes.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Can we start to focus on the earnings now? That is the question as we keep our eye trained on bonds. Good morning. This is Bloomberg Surveillance from New York City. Tom Keene, Jonathan Ferro, Lisa Abramowicz. Tom and John are off, maybe shopping at Hermes. Luckily for us, Manus Cranny, as well as Cameron Dawson of New Edge Wealth, joining us. Cameron, joining us for the hour. Good morning.
Good morning.
Lovely to have you. It's such a morning of angst, really, when it comes to whether it's the bond market or whether geopolitics.
Yeah, certainly. And I think that we've seen so much of this volatility, the question of, is it going to stay around? Have we seen that local peak in yields? Can we get a little bit of relief? Or is this just another sell-off in the move even ever higher and pressing up towards that 5%?
And Manus, that seemed to be what happened yesterday, although the fact that people are blaming Bill and Ted's excellent adventure, which you called the Bill and Bill, excellent adventure, which I'll let you explain because I'm going to get all sorts of heat for saying this. But there's a question of whether Bill Ackman came out and said he was closing his short on long bonds, and then everyone went and bought. I personally don't buy that. Please. Do you buy that in any way, shape, or form?
Not at all. I mean, okay. I think what he says, well, maybe I'm wrong. Maybe the whole market did listen to Bill Ackman and to Bill Gross. I think there was something of an extremely stretched steepener trade, which everybody's banged the drum on for the past number of sessions. The market wanted to test 5. It wanted to take it out, test it, punch it, go through it. And what you have is just a recalibration. That's my personal take on it. I've been in this pain trade for long enough. So,
how much of this is just being very oversold into resistance or overbought into resistance on yields, meaning that you move so far, so fast into that important psychological level that anytime you get to that overbought state, it's likely you're going to see digestion.
Well, at this point, though, there is this question about treasuries and their ability to act as a haven asset. I think that the underpinning some of the angst of the moment is the fact that we do have these geopolitical tensions, which are truly raising some serious concerns about the ability of the U.S. to respond. Is that what we have learned this week, that treasuries no longer are that haven?
They eventually will be that haven. I think some of the reason we've seen that upward movement is we've had a buyer's strike. The data hasn't been that bad, so people look around and say, how much safety do I need? But if they're starting to worry about the data, then that's when you start to see people step back in.
And that's where Bill Ackman said, look, there's too much risk in the world to remain short bonds. So for him, that was part of the thesis about why he wants to buy. But he went on to talk about growth. He said the economy is slowing faster than the data actually points to. And you pointed out the Atlanta Fed data yesterday at 5.4%. But the bottom line is, with so many geopolitical risks out there, with so many unknowns there, and potentially a slowdown, maybe this is part of the Ackman narrative, but I don't think we can attribute Bill Ackman and Bill Gross as having delivered such a virulent move in the longer end of the Treasury curve.
Probably wise. A bunch of people looking at earnings right now, Cameron.
It is very important because it gives us an indication about where that future path of growth is going to be. Manus, you had a really interesting interview this morning talking about signs of weakness within the beige book for the consumer.
Fact of the day from MUFG.
And so how much are we going to see that show up in the earnings that we have? That will show up in even some of those big tech names, which have been benefiting from this better consumer, this better cyclical environment. But what if that starts to slow down, mostly in 24, where estimates are forecasted to have 12% growth next year?
It is a confusing stew out there. And right now, equities are getting a little bit of a bid after yesterday's turmoil, which actually did not see equities get rewarded as much as yields plunged as much as 19 basis points on the 10-year. Today, you could see about a 0.5% gain on the S&P 4263. 10-year yields just marginally higher. But to me, this is interesting. The fact that they started the day lower after yesterday's plunge, now shifting higher. Wait till the end of the day. Who knows what's going to happen? It's been a wild ride. And crude up about 0.4%. When we're looking at today, after getting some negative reads on the U.S. European economic output, we get U.S. S&P Global Composite PMI data at 9:45 a.m. Today, we also have the Future Investment Initiative Conference in Riyadh. We have been hearing from interviews all morning. We're going to be hearing in about 15 minutes from Jamie Dimon of J.P. Morgan in conversation with David Rubenstein. And today, earnings. We should have been talking about earnings. All of this time, we're talking about all these macro concerns in the bond market. Alphabet and Microsoft are reporting earnings after the bell. They are really the big winners of this year, delivering 55% and 37% returns year to date, respectively. At what point can we turn our focus back to earnings? And angst that's sort of underpinning people who want to get back to those fundamentals. Sam Stovall among them, Chief Investment Strategist at CFRA. Sam, when can we care about earnings again?
Good morning, Lisa. Well, actually, I think we're caring about earnings currently because that's one of the factors that I think investors are feeling nervous about. It's not just interest rates, it's not just oil prices, but also will we have a fourth consecutive quarter in which we see S&P 500 earnings decline? We're not really seeing an upward move in these earnings forecasts for the third quarter, and I think this will be a very pivotal week for that to take place.
Sam, good morning to you. It's Manus. Where are we most at risk in this earnings season? We've got big tech, a little bit of big tech today. We've just had GM remove their guidance. They've removed their guidance because of the strikes. But where are we most at risk in this earnings season?
Good morning, Manus. Well, I think the at risk would be where the greatest expectations are. Consumer discretionary expected to see about a 15% rise in year-on-year earnings. Communication services up 27%, so very strong advances there. Conversely, the bar is set so low that you are reminded of an old adage that rarely do you injure yourself falling out of a basement window for energy as well as for materials and healthcare. So some areas are expected to do very poorly and could therefore end up surprising to the upside.
Now, I'm always impressed when somebody gets up early enough to watch Bloomberg Brief, and Cameron did that for us and reminded me of part of the interview that I had with Derek Halpenny of MUFG, and he's done some backtracking on the Beige Book, and I think he said he'd found the most references to a slowdown in the consumer, a weaker consumer that he'd seen for really quite a while. Is this where we see sort of the lights go on in terms of perhaps the constraint on the consumer, or is that a 2024 realization?
Well, I think that the consumer is still holding up quite well. Most recent retail sales numbers showed that. Employment data is showing that. We do expect, despite the very strong expectations for Q3 GDP, up 5% or more, possibly, that we will then slip into a softer mode in the fourth quarter of this year, first half of 2024. So I would tend to say that whatever concerns you would have on the consumer are likely to be pushed out into the new year.
Sam, do you think that as you look to 2024, earnings estimates are too high or too low?
2024, the number has remained fairly constant at around a 12% gain, with a sequential upward move starting in the fourth quarter of this year through each of the 4 quarters of next year. By the end of the year, we're expected to see all sectors in positive territory, with 5 of them posting double-digit increases. So I would tend to say that because these numbers have not really changed, that they are at least where analysts are willing to leave them for the moment.
Do you think as you go into 2024, given that you're talking about better earnings for things like energy and healthcare, which were left behind this year, that you could see a leadership rotation next year?
Well, that's certainly a possibility. What I have found is that the adage of let your winners ride continues when you move from a positive year to the new year. Last year, however, things were quite different. You want to actually rotate from first to worst, meaning that you go from those groups that held up the best during the market declines, such as in 2022, and you move to those that were beaten up the most, which were communication services, consumer discretionary, and tech, the best performing groups this year. So for next year, yeah, you might see an improvement of those groups that underperformed, but following a good year, you tend to let those winners ride.
Sam, how much can you have conviction at all at a time where 10-year yields are bouncing around like a ping pong ball?
Well, first off, when you think of a ping pong ball, the first drop is the greatest surprise, but each successive drop, it's lower and lower. These concerns have been with the market for quite some time, so my belief is that they're having less and less of an impact on the overall market. The S&P is down a little more than 8% with all of these headwinds ahead of us, so why is it then that the market has not reacted more to this? So I would tend to say that investors are looking for any glimmer of hope to start a end-of-year rally.
Okay, if that is the case, is that bullish or bearish, right? I mean, if people are looking for any hope, are they understanding the implication of 5% yields? Maybe not right now, maybe it's now 4.8%, but of higher yields on some of these companies that still have very low financing costs left over from the pandemic era?
Well, I think that because this higher yield situation has been with us for a while, 525 basis point increase over a year and a half certainly has been a record pace. And I would tend to say that because the market has held up so well, that investors do expect some sort of a slowdown, but certainly not a collapse. So I would tend to say that prices lead fundamentals. And if we start to see an improvement in those prices, then fundamentals are likely to continue to improve in 2024.
So a drop but not a collapse. And in terms of the biggest risk is perhaps the capital movement from bank balance sheets to elsewhere. How concerned are you that there's something a little bit more malevolent coming down the pike in terms of the banks like we saw in the springtime with some of the bank runs?
Well, I would say that the regional banks are still going to be having their challenges. Expectations are for about a 26% year-on-year decline in earnings for the third quarter. That's expected to last into 2024. Yet we started the quarter with the large banks expected to show less than a 3% earnings increase. Now that earnings gain is forecast at 16%. So the behemoths are actually doing quite well and are really holding up the banking universe. I would tend to say that typically banks are doing well in the first year of a bull market, which is not the case this time around. It is a bifurcated situation with the large banks holding up well price-wise, whereas the small banks really being underwater.
Fortress Diamond kind of reigning supreme. Sam Stovall of CFRA, thank you so much. And talking about JP Morgan, Jamie Dimon scheduled to speak any moment. If you are just joining the program, we are seeing a bit of a lift to the market. Bonds kind of trying to find direction after a tumultuous period. S&P futures up 0.5%. Manis, I'm glad that you mentioned the banking sector. And Cameron, I'd love you to weigh in on this because something that really people have not been talking about are the regional banking stocks. Mm-hmm. And they've gotten absolutely hammered, and they're actually trading very near the lows going back to March. Are we missing the forest for the trees when we talk about a crisis averted? Has it been?
Well, we have to consider two big things. The first one, of course, is slowing loan growth and how much of that drives their ability to continue to drive that net interest income. The other part of it is the balance sheet, because we know as yields have gone up, they have that held to maturity loss that continues to swell. The Fed is allowing them to push out having to recognize that loss because of the BTFP program that they put in place during the bank collapse. That expires in March. So how much longer are we going to be able to push off that kind of realization of some of those balance sheet issues?
That, to me, is one of the big questions. And Manis, I think it's good that you brought that up, because are we seeing things break just slowly?
Yeah, I mean, we're used to these cataclysmic things just happening right in front of us, sort of overnight or over a weekend. But look at the issues coming at us on multiple fronts, not just from the bond market, geopolitical risk, oil prices, and a number of people coming in around this desk and other desks and saying you're going to get a second wave of inflation next year, and that perhaps. Well, okay, you're shaking your head.
I'm not shaking my head about that. I'm just saying, what more? Like, not another thing. I mean, is it going to be Existential Tuesday? I hope not. You know,
it's only Tuesday. I get a day off tomorrow. Wait.
All right. Oh, no, I'm shaking my head for that reason, because who knows? This is a theory that we've been hearing about, and we'll talk more about that coming up. We'll also hear from J.P. Morgan's Jamie Dimon in conversation with Carlyle co-founder David Rubenstein. He came out and said that some of those forecasts from central bankers have been 100% wrong. Some fiery words.
Earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power. We're going to make more money. We're going to make more money. And we're going to make more money.
They're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
The Federal Reserve is going to have to raise rates higher, which probably will mean by 25 we may have a soft, we may have a hard landing. That is the only way I see how we're going to be arresting this. But I don't expect it anytime soon.
Larry Fink, BlackRock CEO at the Future Investment Initiative in Riyadh, as people try to grapple with the idea of reinflation next year. This is something that we have been talking about. Manus brought it up just moments ago. Manus Cranny and Cameron Dawson, CIO at New Edge Wealth, both with us right now in markets. We can see a bit of a lift. We do see those earnings coming out. And Cameron, it's just been catching my eye. Everything has been beating.
Yeah, much better than expected. When it's looking at the consumer better than expected, some industrials better than expected. We just got Sherwin-Williams come out. They raised guidance significantly. That's a housing-related stock, right? It's paint, people spending more on their houses. So clearly the consumer in these earnings is holding up better than expected, somewhat confirming that better retail sales that we got in September.
Do you think the whole narrative, the whole story about excess savings running off is we're overplaying it when you look at the wealth report that we both, all three of us looked at yesterday? So do you think the excess savings narrative dropping so aggressively is folly? Should we, the resilience of the consumer is abound in these numbers?
I think that it's a fading tailwind, but It's not a headwind, because the consumer balance sheet is healthy.
But the risk is it turns into a headwind in 2024. That's the debate, isn't it?
Certainly, but if you look at things like consumer credit cards as a percentage of disposable income, they're just back to their 2019 levels, meaning that it's gone up a lot. Consumers are using more debt, but it's not nearly where it was during the great financial crisis. So assets have been growing faster than liabilities pretty much consistently for the last 7 years. The consumer balance sheet still is healthy, even though at the margins it's deteriorating.
So there's a real sort of bigger picture question about composition, and we were talking about this with Tom Tsouras yesterday when he came on and said what you're seeing is that the Fed policy rates have really affected lower income individuals and smaller businesses disproportionately. You have seen this again and again. So when do they start to have a bigger impact on the overall general narrative? Or can you see this dispersion continue where the overall averages keep chugging along?
Well, the thing that lower income individuals and smaller businesses have in common is that they tend to have more of that floating rate debt. It's bigger companies and higher income people who are able to term out their debt, borrow at 30-year mortgages or issue 30-year bonds. And so it's those larger borrowers that have not been pinched by these higher interest rates. It's why small caps and micro caps are underperforming so much. They have more floating rate debt.
But we were just chatting about this in the break. As Gina left, I said, I thought we were supposed to run into some kind of a significant debt cliff moment for corporates, refinancing. They have refinancing. Now, we haven't made a huge deal out of anybody missing the refinancing yet. But as you look at debt costs going forward and you look at the returns going forward with debt costs, surely that begins to impinge as well.
Well, certainly, because eventually you have to refinance that debt. And if you look at the corporate treasury market, or corporate bond market, a lot of them have average yields that are less than the entirety of the treasury curve. So eventually you will have to refinance at these much higher rates. And that's the reality of higher for longer starting to bite.
This is what everyone thought, okay? And this, to me, I'm so glad you brought this up, Manus, because to me, there's been this sort of overhang. Back in 2015, 2016, we were talking about beer goggles. Dallas Fed President Kaplan came on and said, everyone's looking at this world with beer goggles of low rates, and that's why they're buying anything. Anything can look beautiful when you go out and you take a look at assets with low rates, with zero rates. And now you're expecting Armageddon because you've had a world refinance at that, and you haven't. And that's really sort of the surprise. How much can companies survive by just basically relying on investors to force them to stay afloat so the investors don't get totally slammed with losses, right? I mean, this is something that you've been seeing with helping refinance at decent rates.
I think we're just now starting to see the pinch come through because we've been in this for 18 months, almost 2 years now. That's allowed extend and pretend. You can try to push off the refinancing as much as possible because remember, we're also conditioned for the Fed to come in and cut rates really quickly. And the Fed's telling you they're not going to do that. So it's the reality setting in that, hey, I've delayed refinancing as long as possible. Now I kind of have to face the music, and the end result is much higher rates.
So how have you shifted your views over the past couple of weeks?
Yeah, so we have been underweight duration for the entirety of the year, thinking that there was this floor under interest rates because of that higher for longer and an upward bias to interest rates. But now we're starting to see a world where the risk reward simply looks better. If you take a 100 basis point move higher in yields versus lower in yields, at least you have this higher base yield offsetting some of those losses. So when we think for long-term investors, we're starting to find interesting, compelling opportunities, not just within treasuries, but within munis. We're not tactically going full overweight duration, saying the peak in yields is in. There's still a lot of risk, but that's where we're starting to find opportunities at the margin.
I was almost going to give Cameron sort of like her introductory drum roll, because she's in good company, isn't she? She's got Whaley from BlackRock. She's got Alliance alongside you. So what goes through my mind, and I'm going to slightly combat you there, which is, isn't it just fear of being left behind that you've got to pivot on your duration call?
Certainly, of course, we don't want to be too cute with it with the timing, but we're long-term investors. And if you think of it just in terms of asset liability matching and thinking about strategic allocations. So if I say to you then, you're shifting, is it a dramatic shift in your taking of duration, or is it incremental, Manus? In other words, we see an opportunity and we add incrementally. It's incremental because tactically we have not made this call that we say we've seen a peak in yields. Fine. We still see this supply and demand issue where we do know we have higher deficits, and that is increasing supply at the same time that demand is falling. QE is not here to save the day. We don't have the flight to safety bid yet. We'll have to see how data emerges. And we shouldn't forget, we have this big unknown about the Bank of Japan and potential changes to yield curve control policy. What could that mean for demand for treasuries as we go into 24?
Do you think that that could have been underpinning some of the wild moves over the past couple of days?
You can track the ownership of treasuries by Japan, and it's actually gone up slightly. They've sold more corporate bonds, so I don't know if that's necessarily, but it is the fear that they could be less buyers on the margin.
I'm wondering though, just going forward, when you talk about how you are legging in just on the margin to duration, is it out of equity risk? Because we heard this yesterday from Katie Nixon.
Yeah, you have to do it in a very tax efficient way, because if you're selling equities with big gains and layering into bonds, that may not be the best trade. One of the ways that we've been doing it is saying if we have dividend income, instead of reinvesting into equities, we'll reinvest into fixed income, because at the end of the day, if you can get your same return at less risk, then maybe you should do that. Now, how unrisky is long bonds given the fact that the TLT is down 45% in the last 2 years?
Listen, you know what? When you get to my juncture, you sort of say, you know what? 10-year paper actually doesn't look too bad. Maybe at 5%.
Well, that's what a lot of people seem to say. Basically, it got to 5%. The market basically said, we reject that. No, we're going to pounce on that.
But it comes, actually, you're back into sort of general historical norms, if I'm not wrong. I mean, we are Many people out there are flummoxed by rates at 5%, paranoid at the risk of 5.5%. The reality is, when I took my first mortgage in 1994, it was at 7% in the United Kingdom. I have lived through 7% and 15%. So for me, it was free money at zero. It was free money at zero. Now I'm choking at 8.
I've got to be honest, these conversations, when people say this kind of stuff, they kind of bug me a little bit.
Why?
No offense, but just because the world was so different then. Prices were different. They were more adjusted to a 7% rate. How much do the prices of assets change the scenario when you have high prices that were backed by low rates, and then all of a sudden you've got to deal with the rate going back to where it used to be?
Yeah, you were able to see house prices go up 20% coming out of the pandemic shutdown, simply because the average mortgage rate did not reflect that, because mortgage rates were falling so much, or the average cost of paying for that mortgage. So now when you add very high prices to very low interest rates, that's where it becomes simply unaffordable.
Torpedoed.
No, you can come back at me next time, because honestly, you are correct, and I think that it's a valid point. But so many people have come on here and said,
it's really
you weren't around. Well, you weren't around, but I remember I took out a mortgage. It's like, well, you know, come on, it's a little bit of a different scenario. Coming up, we're going to have a conversation with the GM CFO. Welcome back. This is Bloomberg Surveillance. Tom Keene, Jonathan Ferro, Lisa Abramowicz. Tom and John off, maybe shopping at Hermes, maybe going on a cruise. I know that John loves those. Manus Crenny here with us, as well as Cameron Dawson of New Edge. We're very happy to say, seeing a bit of a pop in the markets, especially as we get earnings trickle out through the day. Maybe today will be the day the earnings will take the narrative over from 10-year yields, because that has been the narrative for months now. S&P futures up 0.6%, climbing from earlier. 10-year yields just up marginally higher, but really sedated considering where we've been. 4.87%. Crude popping by about 0.5%. Euro softness after what we saw out of that region economically. Under surveillance this morning, Hamas releasing 2 more hostages as a potential ground invasion by Israel into Gaza is delayed. National Security Council spokesperson John Kirby saying yesterday that U.S. officials are in talks with Israeli officials about a possible offensive, but would not dictate terms. French President Emmanuel Macron is the latest world leader to visit Israel and is meeting with Prime Minister Benjamin Netanyahu today. And Manus, to me, it seems like there is a shift in tone from the U.S. government, as well as from other governments around the world, trying to push for maybe delaying or putting off some sort of ground invasion indefinitely to try to get some of the conflict under control.
Well, we certainly moved to some kind of a holding pattern relative to where we were at the close of business last Friday when we went home. Macron, let's see what his narrative is, whether it's a move, a rhetoric around ceasefire, which is what the gathering of the Arab nations in Egypt over the weekend were perhaps saying there was not enough of a discussion around that. But you're right, we seem to have shifted into a holding pattern. That holding pattern has had a significant impact. It's, I think, from the US side, pushing to tell us what the strategy is, tell us what the end goal is, and tell us how you see Gaza post any, let's say, taking out of Hamas inside Gaza.
Cameron, there's been this question around how to understand the signal from the noise in this horrific conflict at a time where U.S. government officials have come out and raised the issue of imagery, some of which is manufactured, some of it is not, the battle of information. What are you looking for to understand what we're even dealing with at a time of a fast-moving conflict, and one that people say could have influence over assets and everything else, but it could not?
I think the best signals will be from oil and from gold. And oil prices moving higher will be an indication that it could be a broader conflagration. And gold moving higher would be a signal of that flight to safety bid. And if either of those reverse lower, then maybe it's that sigh of relief that issues are contained and we can get towards resolution. Moving higher could be a signal that things could get worse.
And there's this also issue of the U.S. ability to respond. House Republicans trying to get their act together with a vote today on a new nominee for Speaker of the House. Not sure if there are 9, not sure if there are 8 candidates. Multiple rounds of voting are expected to take place behind closed doors, with Congressman Tom Emmer of Minnesota seen to be the favorite among 8 candidates. It feels like it's important, Cameron, for there to be some sort of, resolution to this leadership at a time when people are looking to the U.S. to be able able to respond to not just this, but also a government shutdown, also the potential for a budget deficit that's climbed by $1 trillion over the past year.
Yeah, exactly, which is, it's probably one of the reasons why you've seen this uplift in yields, is just that there doesn't seem to be any appetite for budget restraint. And if you look, even the Congressional Budget Office has, which tends to be a little bit more aggressive assumptions, has the deficit only improving to 6% next year as a deficit to GDP. That's still really high in a world where GDP is projected to remain strong. So what happens if GDP were to weaken and we actually have a recession and you have those counter-cyclical measures kick in, where does the deficit go then?
Well, that deficit funding is part of the biggest issues in the bond market. And a lot of guests come in, they sit down, they talk about supply, and they talk about that mountain of supply to the bond market. And at some juncture, if you don't have the natural buyers of banks, the natural QT, and you don't have those natural bulwarks of the bond market that have been there for 10 years, and if the structure of that has changed, that's when your risk changes from the supply side.
Especially if you don't have the price-insensitive buyers. That was Dalip Singh of PGIM Fixed Income, his point earlier. Talking about price insensitivity, Coca-Cola raising its full-year outlook, citing stronger performance this year despite price increases and other consumer pressures. This key example that Cameron noticed right away, price mix or price changes across a range of products and packaging increased by 9%. Analysts were expecting a price mix increase of 6.2%. And guess what? Volume still increased by 2%. And to me, Cameron, this really highlights where we are, that companies are still passing along price increases, and they're still increasing the volume of sales.
That is so important, because what we've seen in other companies is that if you raise price, you give it up on volume. But the fact that you're able to keep hiking price and continue to have volume expansion shows you that the consumer is absorbing those prices. But then it's the guidance about next year. Can they continue to raise price at that mid to high single digit level? What does that mean for revenue growth? And then what does that mean for margins?
You know, it's interesting. We talk about demand destruction often inside the oil market, the commodity market, and the super cycles there. You look at Nestle, they're also raising prices selectively across, guess what? Two beautiful things, chocolate and coffee. And Netflix raised their prices. So the whole, and this is where I'm curious in terms of the equity allocation, is it a little bit more consumer discretionary, even though you see some of the tailwinds turning to headwinds next year? In the interim 6 months, is it still a little bit consumer discretionary?
Well, we are seeing less pricing power in bigger ticket items. So Tesla, of course, is having to cut its prices, which shows you that consumers can still handle the lower ticket items. It's not eating into their budgets as much. For us, the most important ratio to watch is equal weight consumer discretionary versus consumer staples. That will sniff out a turn in the expectations for consumer growth. You equal weight to remove the impact of things like Amazon and Tesla. That's still in an uptrend, which just tells you that the consumer is still in an uptrend.
Taking a look at some of the other stocks that kind of speak to that uptrend, just want to look at Verizon, shares popping. I heard that, some people on this desk have helped that. Menace, including Fios, really helping the profitability there. Those shares up 4%. General Motors, shares up 1.7%. At one point, they were up about 3.5% after really beating earnings, but they withdrew guidance on some of the strikes. And we're going to be speaking with Paul Jacobson of General Motors about that shortly. And Coca-Cola, we were just talking about that beat, up 2.3%. So it's sort of interesting to see how the response to this, decent, but muted. And that has been sort of the overarching response. Let's see what we get after the bell with Microsoft and Google. Right now, to understand really how this is playing out beyond just the U.S., Damian Sassower, Chief Emerging Markets Credit Strategist at Bloomberg Intelligence, joining us right now. And I do wonder, we're talking about the volatility in the Treasury markets, how much you see the spillover really kind of happening in the developing world, that basically DM catches a cold and the rest of the world catches a flu.
You know, Lisa, I just can't get over the fact that anything Manis says, it's almost like he's complaining about prices in the U.S., like since he's been in the seat. But for me, really the price you need to look at mostly is the price of oil. So I have to agree with Cameron here. I mean, you haven't really seen yet, as we have seen in past episodes of conflict in the Middle East, oil prices really kind of spike it. It takes some weeks for it to really filter in to oil. And oil prices obviously are the mechanism for which to do that. What's interesting, though, is when oil prices go, so go credit spreads here in the U.S. And that includes emerging market credit spreads. So that's kind of where I'm focused on, because outside of that, if you look at reserve adequacy levels, if you look at current accounts across the whole of the major emerging market complex, things look kind of okay, you know? And even if you look at refinancings, you look at the debt that's coming due over the next 2, 3, 5 years, it looks manageable, at least for the majors. Now, out along the frontier, in places like Argentina and, you know, Vietnam and Ethiopia and all that, yeah, things are going to get a little painful for sure.
Yeah, just for the record on the whole sort of price rises, you know, you just got to set
Verizon,
the record.
Netflix, Tesla. I mean, I'm hearing
I haven't got a Tesla. I have got a little bit of Netflix. I'm just grateful for the visas. So let's just keep everybody off. You know, I don't want an anti-Irish sort of momentum building against me. On the note, you name a number of big risks there. The oil market has been incredibly well behaved. This is my humble opinion, incredibly well behaved in the light of some serious geopolitical risk, with constraint from Russia and Saudi Arabia at the same time. When you look at emerging markets, we've run our analysis at Bloomberg, and on a major escalation, oil could get to $150. As you look at credit, on an escalation basis, what kind of warnings, you know, where is the most at risk? Who's swimming, you know, without any, who's there with it when the tide goes out with the shorts down in credit?
Well, it's Southeast Asia, right? I mean, the Asian currencies are already reflecting that. I mean, they are oil importers. They're ones with, you know, kind of, you know, you can actually see that a lot of their central banks are actually finally reacting to inflation. You know, they're hiking rates. Indonesia had a surprise hike just the other week. So, you know, we're seeing, I think, if oil prices do rise, you're going to feel it the most in Southeast Asia. You'll probably see that reflected in the currencies initially. What's interesting, though, about EM currencies and commodity currencies in general, I mean, if you look at Colombian peso and a lot of these proxies for oil prices, they're really not correlated the way they were in years past. And Latin American currencies specifically, I mean, we got some better than expected data out of China last week. You'd have thought that maybe, you know, you'd see a better reaction to that, Chilean peso and what have you, but they're just not reacting the way we've seen in years past. And that gives me a little cause for pause.
We see this better data from China, and yet yesterday we had the Shanghai index close below its October 2022 low. What drives that higher?
Oh my God, you're talking about foreign investment in Chinese equities. I'm not going to go there. But yeah, I'm a fixed income guy. But look, I mean, look, the reality is I think demand for anything that's non-dollar denominated in this market, it's going to be that much more challenging given what we're seeing out of the Middle East, right? I mean, I think, you know, we've seen the move in safe havens. We've seen the move in Swiss franc. Yen has yet to react. I think that's the one we really have to keep a close eye on, quite frankly, Japanese yen. And so if I had to look put my macro hat on and kind of look at where, you know, things aren't moving as quickly and kind of reacting the way they would, Japanese yen really stands out to me as one where, you know, if you are kind of looking for a safe haven and you're looking for one that hasn't really followed the masses, you probably look there.
You're such an expert at this. You just say, I'm not going to talk about this, then you talk about Japan. But I do really want to double down on Cameron's point, because there was some interesting stuff over the week. So
you've opened Pandora's box here.
I've got to be honest.
I do this all the time now.
Xi Jinping came out and he made this unprecedented visit to the People's Bank of China, seeming to signal he cares more about the economy. So it raises this question about stimulus. Do you buy into that, or do you just basically say, I'm not going to go there. It's not investable for me, maybe other people. And so, you know, if you want your analysis, go elsewhere.
Well, I think, you know, Cameron, and look, I mean, I'll defend this. Is 0 the right number to have in terms of Chinese exposure in your portfolio? Probably not. Now, the question is, how do you want to get your China exposure, right? Do you have the flexibility in your mandate to go to Chinese equities, to go to Chinese credit, to go to, you know, Chinese high yield credit, property credit? Probably not, maybe, I don't know. I mean, certainly it's in a lot of your EMB or your EM ETF, to throw acronyms out there. But, you know, for the reality is, yeah, so it's probably not 0, but, you know, is it 2, is it 5, is it 10? That remains to be seen. To me, it just seems like a trade. It seems like a trade on a rebound in Chinese growth. It seems very directional. It seems something that, you know, yeah, it doesn't seem like it's got this, you know, the sustainability for multiple quarters to play out. It seems like a trade to me. So that's kind of how I would play it.
Damian Sassower, thank you. And that's wisely said. So I appreciate that. At Bloomberg Intelligence, it's so difficult to really game out what's going on. What we are seeing right now is a bit of a pop in markets in the heels of U.S. earnings. S&P futures up 0.6%. And Cameron, I'm not going to totally let you off the hook either, because there is this question about what you do with the stories coming out of China, and this question of Xi Jinping going to the People's Bank of China, and this idea of the possibility of stimulus, but then a fundamentally changed economy where U.S. companies are really moving out of Hong Kong, anecdotally and by data, at a pretty significant pace. How do you play it?
Yeah, we usually have a policy of not trying to catch falling knives in a highly uncertain regulatory environment where I have no information edge. However, there's a point where something gets so oversold, so unloved, so uninvestable that it starts to look interesting as a trade, not necessarily as a long-term investment. So anything in the area has to be done in a very risk-managed way because we see this great uncertainty from a policy perspective that, frankly, I don't have any edge on in order to get a read on.
It's amazing how last year BlackRock were with me when I was in the Middle East and said, quite frankly, we can live without China, a little bit of China for the moment. So we go through these moments of change in markets. Next year, how important is it, because we're on the cusp of deflation, disinflation in China, how important is that for the world in terms of what happens next in China in terms of stimulus?
It's extraordinarily important, mostly for cyclicals, because China is a cyclical buyer of things like commodities and everything that feeds into that ecosystem. And I thought last week, which was really significant, machinery stocks started to trade really poorly, despite the idea that the PMI is going to be recovering early next year.
I love what also Fadi Birol of the IEA had to say, that maybe it's not going to make as much of a difference to oil prices anyway. Coming up next, Paul Jacobson, CFO of General Motors. He is going to talk about withdrawing guidance as a result of some of those strikes.
The bottom line is we've got cards left to play, and they've got money left to spend. That's the hardest part of a strike. Right before a deal is when there is the most aggressive push for that last mile.
Shawn Fain, UAW president, speaking last Friday, maybe indicating that we're reaching that last mile, maybe not. We are focused on the auto manufacturers at a time of great uncertainty. I want to get right to it because we have a fantastic guest with us to understand what the implications from some of these labor negotiations are going to be longer term. Paul Jacobson, CFO of General Motors, joining us now. You did report earnings earlier this morning. You beat estimates, but you withdrew your $14 billion profit forecast because of the uncertainty due to these strikes. Do you think that it will materially affect the outlook given the contours of where negotiations are right now of 23 to 30% increase?
Well, good morning, Lisa, and thanks for having me. You know, just before I start, I would like to just give a big thank you to the entire GM team for an outstanding quarter across the board, including the employees that are working every day and producing the high quality vehicles that our customers love. It's a strong testament to everything that we're going through right now. You know, when we made the decision to withdraw the guidance, it was really based on not wanting to speculate on the length or scope of the strike. You know, clearly this has been a very different UAW leadership strategy and one that we've adapted to. But at the same time, given that we don't want to speculate where the next plant might be or how long that might be out, we thought the prudent thing to do was to withdraw guidance, despite the fact that the underlying business was actually performing at the top end of our range prior to this. So we'll provide an update with investors as soon as it's over, but we're still focused on making sure that we execute every day.
Can GM make a profit with a 25% raise for the UAW like Shawn Fain has requested?
You know, what we need to do is obviously strike a balance. We've said from the beginning that we really want to reward our people for the quality work that they're doing at each and every plant, each and every day, and that's a testament to the demand that we've created for the vehicles that we're producing, which I think is the best portfolio in GM's history. So what we've also got to do is make sure that we sign an agreement that allows us to compete in the global marketplace. When we look at the pressures and the challenges on EV profitability, as well as some of our foreign competitors, we've got to make sure we can continue to price our vehicles and produce our vehicles profitably, which gives us the cash to be able to invest in the next generation, not only the models, but the plant refurbishments and the transformations that we have to do. So we've got to be able to strike that balance of rewarding our people, but making sure that we're absolutely able to invest in our future.
Does 25% allow you to strike that balance?
You know, I think it does. We're not going to sign a deal that doesn't allow us to be competitive. You know, there are obviously challenges that the team's responded to over the last few years, whether it be COVID or the semiconductor shortage or supply chain issues. The team's been remarkably resilient, and I think this is another challenge, but one that we can rise to, and I believe that we can still hit our goals.
Paul, very good morning to you. You've withdrawn the guidance. We've cleared that away. I'm curious to know, if you're withdrawing guidance, is there any risk to anything to do with dividend? Any guidance on that? Obviously, dividend and buybacks were reinstated just last year after a 2-year hiatus. So is there any quirk there?
Well, Manus, I would say that, our balance sheet is incredibly strong right now with about $50 billion in total liquidity available to us. We went out and we got an additional line of credit about a month ago to make sure we're prepared, because while the uncertainty and while the team is working at the bargaining table in order to try to find a deal, we've got to make sure that the business continues to run. We make the investments we can. We fulfill the commitment we've made to our shareholders, and we continue to do business as usual the best we can. And the strong balance sheet is going to enable us to do that.
As I was sort of getting more familiar with the dynamics of this strike, I've just landed in this country after 5 years somewhere else. The question that goes through my mind, to close these strike deals and to deliver on pensions, it's a very British thing. I'm curious, do you have a number that you will have to contribute to the defined pension? This is one of the most contentious parts of the negotiations, as I understand. So is there a number that you're going to have to make good and restitution to the pension to make this deal good?
Well, our defined benefit plan, which has been frozen for quite some time, is actually funded very, very strongly right now, and we feel good about that. The participants participate in a defined contribution plan where, under the current agreement, we contribute 6.4% before an employee has contributed anything. So there's a good balance across the retirement plans, and we think one that's very favorable, and one that we've been able to adjust the business to make sure that we can put into the calculus going forward. So anything that we do to retirement goes into that bucket of what I said earlier, which is we need to be able to compete in the global marketplace, and where we spend our money isn't necessarily as important as how we spend it. So we're really trying to strike the balance as to what's important with the UAW.
If you had Elon Musk in front of you now, and you were talking about prices, I bet you wouldn't be having a nice conversation. I mean, how brutal have his price cuts been for your plans for 2024 in EV?
Well, when you look at what our average transaction prices have done this year, they've actually been remarkably stable in the midst of it. Now, that's primarily the internal combustion engine portfolio, which I would say is not necessarily a direct competitor with EVs, although EVs do work to try to disrupt ICE vehicles as much as they can. So it's one that we've been really competitive. When you look at our EV slate, we've kept our pricing very stable, and while we're delivering in smaller quantities than some of our competitors, we are expanding rapidly. We have a strong order book that we're fulfilling, and customers have stuck with us through this. So in the third quarter, we produced about 2x the number of Ultium platform vehicles as we did in the second quarter. So we're growing rapidly, and pricing has been very stable for us and our products, and our customers have stayed with it.
Paul, do you think that the prices of vehicles are going to go up because of the strikes?
Well, we've seen some tension, and obviously when you look at the inventory levels, there's a little bit of challenge. We saw some increases in the used car market in particular, leading up to the labor stoppage. So we're watching that closely. Obviously, the consumer has seen a lot of pressure on monthly payments as a result of higher interest rates over the last couple of years, but that's something that we strike a strong balance with. But it all starts with having strong demand for your portfolio of vehicles, and right now GM's got a very, very good demand book.
How much is demand starting to wane, though, especially you talk about taking out loans and how much interest rates have gone up, and we've seen that subprime auto loans are seeing delinquencies at rates that are unprecedented in data going back to the early 1990s. How much is that impacting? How much do you expect demand to grow going forward?
We really haven't seen much of an impact, Lisa, on that demand. It's been pretty consistent. So when you look at our average transaction prices, they're actually up year over year. Wholesale volumes were up about 2% in the third quarter. They've been up about 8% year to date, and inventory hasn't built. So we're moving the vehicles that we're producing, despite the fact that that monthly payments have gone up and prices have gone up. So I think that's a strong testament to the products that we have. We've obviously got to watch that and make sure that we're running the business to be resilient. And that's one of the things that we have to strike in the labor negotiations, is we've got to strike that balance of making sure that we're rewarding our people while balancing the need to compete in the global marketplace.
Just real quick here, Paul. Can the U.S. truly compete with China when it comes to EV production, when it comes to EV sales?
Well, I think when you look at what Tesla's done, when you look at the infrastructure that we're building, not just in the battery joint ventures, but also in the raw materials, we believe we can be competitive with China. And our vehicles that we've gotten out, the customers love them, and we think there's a lot more to come from the General Motors team.
Paul Jacobson, General Motors CFO, thank you so much for being with us. Cameron Dawson, final word from you on how much you're looking at auto manufacturers and some of these potential labor negotiations and challenges coming to the fore.
I think that'll be a really important indicator about wage pressures and margins going into 24, because the labor market still is very tight. There is negotiating power for labor. So if you continue to see that, you have to square that then with pricing power of companies, because if that starts to fade, your costs could still be going up, and yet you'll have less ability to pass on that increased cost to your end customer.
Are you buying automakers?
No.
That was one of the longest says. That was brutal.
We are long-term quality investors, and these are great franchises. However, we care about balance sheets a great deal, lower leverage, high free cash flow, high return on invested capital. These typically have been very capital-intensive businesses, not with those conditions.
Cameron Dawson, come back soon. Wonderful to have you. Thank you so much for all your insights of New Edge Wealth Management. Coming up, we will have words from JP Morgan's Jamie Dimon, which has been delayed. We will bring that to you. We're also going to be speaking with Matt Luzetti of Deutsche Bank.
Those higher interest rates are going to bite all corners of the economy.
The bond market is helping the Fed slow the economy.
By the time we get into the first quarter of next year, I think we do have a mild recession unfolding.
One way or the other, Fed will lower inflation and continue to lower it.
If you look at equities, it has yet to reflect the higher rate environment.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
I think we can say today is about earnings, at least so far. Welcome back. This is Bloomberg Surveillance from New York City. Manus Cranny alongside me, as well as Matthew Luzetti of Deutsche Bank. John and Tom both off today, I believe, taking a cruise together in Cairo. Right now, though, we are looking at a situation where we've been wondering when we can stop focusing on what we're seeing in the bond market and look to earnings. Matt, so good to have you here.
It's great to be here. Thanks for having me.
I wondered, from your perspective, I mean, don't you feel like at this point yields have taken on a narrative of their own, even away from economic data, even away from some of the machinations in the global markets?
Absolutely. I think that the bear steepening that we've seen in the curve over the past several weeks and months has really driven everything. I think as we woke up yesterday, you saw the 30-year yield near 5.2%. And really just the big reversal that we saw yesterday driving markets at the moment. It's also driving central bank policy. I think what we've heard from the Fed is it's a really important driver for why they're not going to raise interest rates next week. I think it's a really important driver for why they're a little bit concerned about raising rates further. And so it'd be really important whether or not this reversal that we've seen in the long end of the curve is sustained, or if it's just a blip with the train that's moving forward.
Well, at 486, I mean, they're up 5-6 basis points this morning. So here's the conundrum, isn't it, for the Fed? If the dirty work was being done by the bond markets at 5% and higher on the longer end of the curve, are they going to be uncomfortable if these yields begin to retrace more materially than what we saw yesterday?
Yeah, I think that is definitely the conundrum for them. They talk about it doing some substitution in terms of rate hikes, but to the extent that unwinds the move, that it eases financial conditions, especially with the backdrop of the data that we've just seen over the past several months, I think that is an uncomfortable one for them. And so it's this give and take that the Fed has to manage, and it's certainly not an easy one for them.
But Manus, it seems like yesterday everyone was talking about just the wild ride we were seeing. And today it feels like we're able to look a little bit more at the earnings that are coming out better than expected. And to your point earlier, and it's a good one, when do we start to worry about reacceleration of inflation?
Which is something which is 2024, and I think that this is the risk in Europe. I think it's more, we've just had a conversation with the GM CFO, and again, he's talking about pricing in his electric vehicles being stable, but he's going to pay 25% more for his labor when this deal is done.
Right. Well, and though that said, he
if and
did
when
say,
this deal is done.
If and when this deal is done, they did withdraw their guidance because they don't know when the deal is going to be done or what it's going to look like. But he did say they would still be profitable, even with a 25% increase in wages for the UAW workers, which raises a question, hey, is there a lot more to go? I mean, not just with the auto manufacturers, but elsewhere. Do you see that increasing in terms of wage pressures?
Yeah, I think you've seen a lot of heterogeneity. I think over the summer, the Fed was getting a lot of confidence that we're seeing the labor market come into better balance. The quits rate coming down, job openings coming down, the unemployment rate edging higher. Leading indicators for wage growth were quite positive. I think there's just been a tremendous amount of uncertainty from the latest batch of data. The jobs report that we got was so strong, a leveling out in job openings, retail sales that surprised to the upside, the CPI report that was a little bit stronger than expected, but with a really bad breakdown from the Fed's perspective. And so I do think we are entering a couple of months here where from the bond market's perspective, you do see somewhat more elevated inflation than we were seeing over the past several months. And the question is, does the real economy slow enough to keep the Fed at bay?
And stocks are up today, if you want to take a look at that data. And honestly, the fact that stocks are going to have to look at this toxic or just confusing brew, I would say, more than toxic brew, confusing brew, and try to make sense of it every day gives you a sense of why people are just sticking to their guns and looking day to day. And actually, equity market volatility has been much less than in the bond market, which is something we were talking about earlier with Gina Martin-Adams. S&P futures up of about 0.5%. 10-year yields slowly just kind of inching higher a little bit, 4.87%.
Baby steps.
Yeah, I mean, basically, to me, this is basically stagnant, but the day is young, and we've got a 2-year auction at 1 p.m. from the U.S. Treasury. Euro softer versus the dollar, and I think that is interesting in light of what we got overnight, the economic data. Europe's still in a world of hurt heading into that ECB meeting Thursday.
Europe is under a lot more risk. Okay, the gas tanks are full going into this winter, which is very, very structurally different to where we were last winter. But if you look at that euro dollar, there's a resilience in that euro dollar. A lot of people came on the various shows that I've been on calling parity, calling 95 at one juncture, and yet the euro endures. So I think let's see what Christine Lagarde has got to say this week, which might underpin the euro.
Sinead Coulter-Grant, head of investor solutions at BNY Wealth Management. You're going to have to answer that question for us. Basically, how much are investors really looking to Europe as a potential point of resilience amid some of the confusion with the U.S. and the debt profile, or really the point of weakness, which is what the sort of consensus has been for the past couple of months?
Very interesting question, Lisa. Hard to look at Europe as being an area of resilience. So we know that when the Eurozone economy is firing on all cylinders, you're looking at growth in the 2.5% region. And we're very far from that now. I mean, we've already had Germany effectively flatlining for the last couple of quarters. The thing about the US economy that's been so remarkable has been the fact that growth has been so resilient. When you translate that into a currency environment, it's unsurprising that the euro has now started to weaken, really as markets have started to realize that the ECB can't continue raising rates because the economy is stagnating. So it's a pretty unimpressive picture. And when you look at the currency weakness, there's probably more to come.
So the argument would be, a couple of guests came on the brief, shameless plug, it comes on before your show. Want
to keep going?
Is that we're already in policy error? I had a guest last week who said to me, we're already in a policy error in Europe. Would you agree with that? I mean, that takes us back to the times of Trichet and the folly of him raising rates then in the eye of a big storm. Is there anybody in policy mistake at the moment, either the Fed or the ECB? Who's at risk most?
Interesting question, but when we think about policy error, of course, the ECB was the central bank that raised rates in 2008.
Yes.
This time around is very, very different because they have to get inflation under control. The biggest problem a central bank has is when inflation expectations become unanchored. We're not in that territory yet, but we're likely to see more pauses as opposed to the continuous hikes that we have been seeing. I don't think we're in policy error territory yet.
Okay, if we stand back for a moment, yesterday we saw pretty virulent moves at the long end, 30 years, 10 years, all cascading lower. I walked in this morning and I went, why are equity markets just not more virulent on the back of that? And that's the question that I have for you. Why was there not more of an equity kicker on the back of a gargantuan, let me rephrase that, a significant move in the bond market? Let's not over-egg it.
There are many things happening with equity markets at the moment, and earnings are clearly very much in focus. I also think that we're in the midst of a regime shift where we're moving towards much more volatile fixed income markets, right? They have for the last 2 decades been much calmer.
Yeah.
We're going back to where we were in the mid-2000s, in the mid-90s, when you actually saw volatility in markets, well, bond markets specifically.
Just maybe return back to thinking about the euro. I think that there's been, the market has been pricing this constant rate cutting cycle from the Fed. It seems to be a little bit reluctant to price that for the ECB. Do you think that that's what is needed as a driver for the euro lower? I think we talk about the resilience, but there's been this big dichotomy in terms of how market pricing has been in terms of the rate cutting cycle.
The ECB operates quite differently to the Fed, as you know. The inflation mandate is a little different, right? They've got that 2% or lower mandate on inflation, which means that they're slower to change trajectory. Now, having said that, the ECB has really never been in this territory before. But look, as we start to see weaker data, we've had that in terms of some of the PMI data this morning. We saw in the UK, in the Eurozone. Market participants are going to look at that slowing data and then try to move ahead of the central bank, which will weaken the currency.
And now, in terms of, I'm just looking at your positioning. You are neutral on equities. You favor the US over an international exposure. So with that in mind, when you see this 8% drawdown from July to now, the first question would be, does that reflect enough of a reaction in US equities lower to the higher bond yields? And are you just a natural incremental buyer on these dips?
We're long-term investors, and so when we look at the trajectory of equity markets, we're looking out 3, 5, 10 years.
Okay.
Year to date, we were probably as surprised as most were that US equity markets behaved so strongly in the first half of the year. So even year to date, when you take into account the losses in Q3, they're still in positive territory, albeit driven by 7 major names. That recalibration...
The Hallowed 7.
Indeed. Or the Magnificent 7.
The Magnificent 7.
So as we think about the trajectory for equity markets from here, we're pretty constructive on earnings. There's probably a little bit to come down in 2024 earnings expectations. We haven't seen much of a walk down so far. But we do think that markets have started to price in these different expectations for bond markets.
Okay. Sinead Colton Grant, thank you so much for being with us. Sinead Colton Grant of BNY Mellon, thank you. Matt, I have to say, as we talk about how to understand the geopolitics of this, I will say that Europe is one of the biggest question marks. I don't understand the ECB's reaction function. I don't understand how Christine Lagarde is really going to message anything this Thursday.
Yeah, I think it's the perfect environment to wait and see. You know, the Fed's mantra at the moment is proceed carefully, and I think that you'll hear that from the ECB as well. Really not expecting anything on the rate side. I think where the market maybe focuses on the balance sheet. So do we get any indications on changes in QT as we look ahead? You know, I think that's a really important development as we think about the bond market, what's happening in the long end of the curve. But at the moment, I think central banks are proceeding carefully. They're waiting and seeing. There's a lot of risks that are out there, and there's nothing that's pushing them to move urgently here.
And what you're seeing with the euro, and I think, Manus, to your point, we do see some euro resilience given the fact that we might be seeing a recession unfold, at least based on the PMIs that you got overnight. The euro 106.28, just kind of hovering in that 106 level, even after some people were calling for parity. Meanwhile, S&P future is just basically hanging out around that 0.5% upward gain, 42.61. 10-year yields, really, I mean, this is basically just stasis for 0.87%. I will say, Edmund, I am so glad that you're here because there was a story that caught my eye, that Moody's is starting to use ChatGPT to craft their reports, and this is going to be our artificial intelligence segment for the morning. Do you do that too?
We don't. It is something that I think we're looking into. Certainly not for crafting reports, but in terms of thinking about summarizing big groups of text, so looking through Fed communications, I think it could be a very useful tool as we look ahead. Looking at things like titles, I think it can be helpful in terms of a guidance for reports at the moment. But it is something that we're looking into. I think as you look at Deutsche Bank's research and our head of research, David Folkerts-Landau, he's very bullish, I think, on how AI is likely to drive the economy. I think how it's likely to drive our industry. So it's something that we're looking into closely. At the moment, it is not something that is helping us to write reports.
I think it's going to be a leading thing. I think, first of all, I see my kids using it all the time.
Well, I actually went to do some research for today's show, and suddenly the engine that I was using suddenly populated my page with a whole sort of raft of information. Of course, I clicked off immediately and went and did the proper research. But who can, the AI hologram with a personality? That's all that we need to find. Well, and then I'm definitely out of a job.
Well, this is sort of the issue, right? Is this going to be an efficiency metric that will then remove some of the interns? I mean, what do interns do anymore?
They're overpaid, though, on Wall Street, apparently.
Hold on a second, but do they have a job?
No, absolutely. I think as we look ahead, there's certainly going to be some substitutability, but absolutely.
Coming up next, we're not going to be speaking about this, or maybe we will. His Excellency Omar Razaz, former Prime Minister of Jordan, a really important conversation at a time of incredible attentions overseas. From New York, this is Bloomberg.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power. We're going to make more money. We're going to make more money. And we're going to make more money.
They're making bank. And I think that is what we could take away.
Bloomberg Television and Radio. Context changes everything.
We know Iran continues to support Hamas and Hezbollah. And we know that Iran is closely monitoring these events and in some cases actively facilitating these attacks and spurring on others who may want to exploit the conflict for their own good or for that of Iran. We know Iran's goal is to maintain some level of deniability here, but we're not going to allow them to do that.
That was John Kirby, National Security Council spokesperson, as the conflict in the Middle East does continue to escalate in certain pockets. The key question being, though, when do we get further escalation even still, bringing Iran more directly into the fold, bringing some of the other regional actors? This is a person who really has deep insight in both the psychology and the geopolitics of the region, and it's really important to get his voice on the matter. Omar Razaz, His Excellency, former Prime Minister of Jordan, currently a lecturer at Harvard. And Dr. Razaz, I just want to start with getting your take on how far things have escalated and what the chances of things truly turning into a full-blown regional war are from your vantage point.
Thank you, Lisa, for having me. Yes, things don't look good as far as I can see. We all live in a global village. Anything that happens today anywhere in the world can escalate into regional and eventually global level, and that affects everything. It affects the economies of the different countries, especially at uncertain times like these. The problem with the approach to the Middle East and the Palestinian-Israeli conflict has been ignoring it, has been assuming that it will go away, has been assuming that, if we create economic links between Israel and countries in the region, then they will see their mutual benefits, and somehow the Palestinian issue will die. This did not happen over the last 40, 50 years, and it's not going to happen. What needs to be done is to address the cause issue that can be utilized by Iran or others, regional powers. The cause issue is that there's still no two-state solution. There have been commitments over the last 40 years for a two-state solution. The U.S. supports a two-state solution where Palestinians and Israelis can live side by side in peace and harmony. But on the ground, nothing is happening. So people in the region are really frustrated. Palestinians have zero hope, and this creates the ground for what we're seeing today.
At this point, Dr. Azaz, where we are right now, how do you go about creating something like that, where Hamas is the leading institution over Gaza and has a real dominant position in society?
Well, the first step is to de-escalate and make sure that humans are not being used in this conflict, innocent civilians. The lack of food, water, medicine is a major issue. Israel has started to allow small shipments of that. This needs to be opened up. The civilians cannot be used as a card in this game. So that's very important. Anybody who's captured during this process, civilians should be returned, and this I think also has started. And so the first challenge is to de-escalate, and the second is to start addressing the fundamental issues here. The Palestinians need a state of their own, and whoever you are negotiating, Palestinians don't choose which Israeli government is. In fact, what we have is a very right-wing Israeli government, and that tends to wants to control all over West Bank and Gaza.
Dr. Omar,
with U.S. and Western pressure, these sides can sit to the table and talk about this ultimate issue of a state, a Palestinian state. Without that, every now and then we're going to get an explosion like we've seen.
Dr. Omar, good morning. It's Manis. I reflect back to the weekend's gathering of the Arab nations. The Jordanian king said during that summit that military solutions don't work. President Macron is there today calling for a resumption of the peace process between Israel and Palestine and the creation of a state by halting of settlements on the West Bank. I mean, do you see this narrative building for a ceasefire? Do you think there's any real possibility of a ceasefire, or will we have to live through some form of ground invasion first?
I think a ground invasion would be catastrophic because there are still over 1.5 million civilians in Gaza. And whenever they move to southern Gaza, they get bombed in the process. So a ground invasion is going to have catastrophic. It will not resolve the issue. It will convince people in the region that this is a one-sided view from the U.S. and the Western allies, that they see Israel as their only ally and they support it no matter what. They give it a green light to carry out what could be seen as ethnic cleansing and war crimes, and that's what His Majesty the King was talking about.
Dr. Azaz, a lot of people would say Israel left Gaza in 2005 and that Hamas did have an opportunity to rule, and you say that the two should come together to come up with a two-state solution. You can't choose the government. But if you have an entity that is designated a terrorist organization and has a goal of killing the other people, how do you negotiate a solution?
Well, first, we can't say really that Israel left Gaza. Israel surrounded Gaza with an iron wall and controls the exit and entry into that region. So it's the biggest open air prison in the world. And I think these types of this becomes a fertile ground for extremists on all sides.
But Dr. Azaz, just with all respect, though, Egypt also blockaded them. There also has not been a willingness for other nations in the region to really open up and to provide more assistance either.
It's okay. Let me distinguish here between opening up to deliver assistance and what Israel and other Western countries have been pushing for Egypt to open up to absorb a wave of Palestinian refugees into Egypt. The first one, the entry to the Gaza from the Egypt side was open until recently, the time it was bombed, and that's when it closed. But the idea that Egypt or Jordan should accept more displaced refugees from Palestine into Jordan and Egypt. That is, the Palestinians don't want it, Jordan and Egypt don't want it, and it's not fair. It's part of the, if I may say, the double standards. Why should Palestinians leave their homeland and become so desperate? That's been the case for many Palestinians living in refugee camps for the last 40, 50 years. So it's not Egypt and Jordan's responsibility. Ultimately, yes, you might not like your enemy, but you have to sit at the table, whoever it is. And by the way, Israel had the Palestinian Authority in the West Bank. And Israel has weakened that Palestinian Authority. Why hasn't Israel negotiated a Palestinian state in the West Bank? Instead, it does the opposite. It arms the settlers to continue to evict Palestinians out of their homes and out of their lands. So I really, without pressure on Israel from the U.S. and its allies, Israel, especially this government, is continuing to do what it's doing, and it's not going to lead to peace, but it's going to lead to escalation.
Yeah, Dr. Omar Razaz, thank you so much for being with us, former Prime Minister of Jordan, as we try to understand how to resolve a conflict that right now does not seem to be in a very good place. From New York, this is Bloomberg. About an hour ago to the U.S. Open, and we can see that lift persisting through the session as we get earnings that do outperform. Tom Keene, Jonathan Ferro, both off, maybe together, maybe alone. I don't know. We'll find out. Manus Cranny very much in, and Matt Lazzetti of Deutsche Bank also alongside me, which is a wonderful and beautiful thing. Seeing S&P futures up 0.6%, 42.65. Yields quiescent. And when was the last time we could say yields quiescent?
That's a beautiful word. Quiescent.
I stole it from Tom. I can't even claim to own that. 4.8%. I know, isn't that beautiful?
That's loquacious.
It's mellifluous. Anyway, moving on. We could see in the currency space a bit of dollar strength, euro weakness. I think this is more of a euro story than a dollar story in terms of some of those PMIs coming out a lot softer than expected in the European region. Crude all over the place. Are we escalating? Are we de-escalating? Hard to know exactly what's going on, and crude is going to work through that. I do want to get a catch up. We've been talking a lot about what's going on in the Middle East, and I do think, Manus, the idea that the U.S. doesn't have a Speaker of the House, the idea that there is so much disagreement, how much does that sort of underpin so much of the discussion?
I think as an outsider, that somebody has just arrived in this country, you look at it as being perhaps on the world stage, not disemboweled, but a weak moment in geopolitics for the U.S. Yes, they're there with the money, and even that's delayed, but it's presumed it will come. But this is a country politically which is really pushing against one another in the capital, not necessarily in the rest of the country. I haven't been outside of New York yet.
Well, when you get outside of New York, you'll realize that it is the rest of the country. Matt, from your perspective, though, how much does this complicate the ability to deal with the deficit, to deal with some of these issues that actually creates a pretty significant drag economically?
Look, I think it no doubt complicates everything. I'm not sure that it creates a big economic drag as of yet. You know, even if we get a government shutdown as November 17th comes up, that drag tends to be relatively limited. It tends to get unwound. You know, we estimated at 0.1% on growth per week. I think the bigger debate, certainly for markets, is where does the speakership end up? Where does the government shutdown debate in terms of fiscal retrenchment, does it lead to any cuts in fiscal spending as we look ahead? The market is focused on supply. It's focused on an environment with a lot of fiscal stimulus in the context of a very good economic backdrop. And so any key changes to fiscal spending over the next year, I think that'll be the key driver for markets.
Of course, we don't know who the Speaker of the House is going to be, and someone who gets to cover that every single day, our Speaker of the House correspondent, Anne-Marie Herdern, down in Washington, D.C. Anne-Marie, what's going on? Are there 8? Are there 9? Are there 7? How many are there? Are there new entrants to the field?
It's a great question. So last night they left this forum, the House Republican Conference, where some of these fresh faces were able to pitch what they would do if they were able to get the gavel. And then we were able to whittle it down to 8 individuals. So it's an 8-man race now. And coming out of that, it does seem to be the individual that is leading the pack is Tom Emmer. He is actually part of the leadership. He's third for the leadership line. He's the whip, so he has a lot of relationships within this caucus. So it does look like today when they go back in and there's going to be ballots, probably like 2 or 3 it's going to be, because you have to get a majority behind closed doors. And then that individual will be the Republican caucus nominee for Speaker. This will be their 4th one. We had Kevin McCarthy, we had Steve Scalise, we had Jim Jordan, and now it's going to be the 4th nominee. Potentially we'll get that name. We will likely get that name today. The question then becomes, can that individual, though, get to 217 on the House floor? And that's really what has made this process so difficult. Even if an individual has the majority of their conference, if they cannot get to 217 on the House floor, they cannot become Speaker.
Well, we've been here before on a couple of occasions, haven't we, with some of the previous candidates. And, you know, the vote ran away a couple of times from Steve Scalise. But does he have the numbers? And where is he fiscally? We're about to have a conversation with a gentleman from Deutsche Bank. So I think what the markets want to know is, who is this speaker? If it is him, how fiscally tight is he?
Well, that's a great question, because if it's someone like Tom Emmer, he's seen by some as more of a moderate, or someone that the Democrats could potentially work with, which is why Punchbowl News this morning is reporting that there's a chance that some Democrats may vote present or may not show up to the vote to make it easier if Tom Emmer does become the nominee, and then there is going to be a House floor vote to help him get and clear that line of getting to 217. The biggest issue that this individual is going to face is, of course, November 17th, we have another threat of a government shutdown. And remember, it was former Speaker Kevin McCarthy who put a continuing resolution on the floor that ended up costing him his job. So are we going to become to another situation like that? We should also note if Tom Emmer, who's the leading candidate right now, but potentially someone like Kevin Hern or Byron Donalds, can pull it through. They both left yesterday saying they're going to be making calls. Kevin Hern said he didn't come here to be number 2 or number 3. He wants to be number 1. But then it becomes, for the next point for this process is, if they do put a continuing resolution on the floor, will they be ousted? If none of these individuals get it, we can get close to November 17th, which is going to be that pressure point, and potentially there's a vote to then give more powers to the current Speaker pro temp, Patrick McHenry. So it's chaotic, and there's a lot of different avenues that can happen. If anyone tells you they know what's going to happen, I think they're lying.
And Marie, as we look ahead, and assuming that we get a speaker elected this week, how do the different outcomes impact resolution of the government shutdown next month? Do we think that Republicans are looking to put the volatility behind them, coalesce around keeping the government open, thinking that it's politically damaging to go through a government shutdown next month? Or should we just expect that this volatility bleeds over into the actual policies as we look ahead as well?
I think you could expect a lot of volatility continuing to emanate from Capitol Hill. That has been a serious place of volatility throughout the entire year. Remember, President Biden had to cut short his foreign trip when he was at the G7. He was supposed to go to Australia so he can get back and deal with the United States on the brink of hitting their debt ceiling and real fiscal calamity. What I would say, though, is that Terry Haynes of Pangea, he has said that the more chaotic this is and the longer this gets drawn out and the closer we get to November 17th, the actually likelihood that we will have a stopgap funding measure go through is easier, because the Republicans will recognize, okay, we wasted a ton of time bickering amongst ourselves, trying to get our house together. We have to keep the government open so we can move along and really get down to the business that many in the Republican Party want to see, which is actually passing appropriation bills.
Anne-Marie Herdern, thank you so much, as always, for your insights. I'm sure we'll be here again tomorrow at the same time talking about how there still is no House Speaker. Still with us is Matt Lazzetti of Deutsche Bank. And I've got to say, from an economic perspective, how do you take a look at this? How do you even understand the deficit and what kind of drag that's going to be when we don't know how much that's influencing yields? And frankly, yields at 5%, very different for the U.S. financial profile than 3.5%.
Absolutely. And I think, a lot of what we see in terms of the fiscal outlook, in terms of the budget outlook and debt outlook, has been known for a very long time. And I think the market has known that you were going to have this big, perhaps, supply-demand imbalance within the Treasury market for a long time. And the question is always, what kind of catalyzing event do you get that brings it to the forefront for the market? And that's what we've had over the past several months. As we look ahead, what could potentially take some of the steam out of the longer end of the curve? We do have a Treasury refunding announcement next week. To the extent that they show that they are taking into account some of the market moves, I think that would be an important development. From the Fed's perspective, communications that they could have are somewhat limited at the moment. Sure, they could say that they are tweaking QT as they look ahead to respond to these bond market moves, but that seems very unlikely, I think. That is only an environment where they're seeing a lack of market functioning, significant illiquidity. Absent that, I think the Fed is simply willing to lean on, quote-unquote, autopilot for QT at the moment.
Look, everybody is grappling and trying to understand what is it that's driving the sheer magnitude of the volatility in the bond market, as we saw last week, and we put on 40 basis points before everything turned around yesterday. There's a wonderful line in the story this morning. The deficit as a share of gross domestic product on an adjusted basis is the widest that it's been and the worst since 1950. I mean, this is the reality, and there is no buyer. There's no permanent buyer, as Lisa and I have discussed this morning, in QT, in QE, excuse me. When you read that kind of stat, you really begin to understand the size of fiscal deficits in this country. And if you don't have QE, does this just get a bit worse?
Yeah, I think one of the most striking charts is if you look at the budget deficit versus the unemployment rate. And typically there is this very nice relationship between the two. Mm-hmm. And that is historically we only run large budget deficits when we have a weak economy. The past 3 years have been historically very anomalous from that perspective. You've had very large budget deficits in the context of an unemployment rate that is incredibly low. I think that's helped to put some steam into the economy this year. We expect that you see 5.2% real GDP growth for Q3. As you look ahead, I think you're right. Some of those price-insensitive buyers that we typically think of, central banks are not there. Banks are likely not there, given what's happening with their portfolios.
These are the stabilizers that Mohamed El-Erian has referred to on a few occasions.
Exactly. And so you rely more on price-sensitive buyers, the household sector, hedge funds. Mm-hmm. And I think that just leads to greater implied volatility. It leads to larger moves. And it does suggest that higher yields are needed in order to make the market clear.
What happened to the concept that was really held high in economics that more debt led to lower rates?
Yeah, I think more debt can maybe coincide with lower rates for a period of time until it doesn't. And I think that's the environment where we are right now.
How much are you concerned then about a reacceleration of inflation on top of this, right? I mean, that you have this, it hasn't worked, and that potentially seeing, based on Coca-Cola passing along 9% price increases and still seeing their volumes increase, is that risk rising?
Yeah, I think when you look across the anecdotes, there's anecdotes on both sides. I think you certainly hear a lot that price sensitivity is increasing. When you look across the Fed's beige book and some of the surveys, there's evidence of that as well. So I think it might be very idiosyncratic where it's not being passed through. But I do think over the next several months, there is this backdrop where inflation could very well firm. And it's well-known items. We know health insurance in the CPI is going to pick up. Used car prices, perhaps new vehicle prices, are also going to be picking up over the next several months. It does create this very, I think, uncomfortable environment, particularly for the Fed, if the economy does not slow. Because it may not be that the long end of the curve move is enough.
Who's more uncomfortable, the Fed or the Treasury, given the current state of, there's a wonderful Irish word, it's not crisis, chassis.
So I think the Treasury has issuance needs that they need to meet, and the question is, how do they meet them the best? They may very well decide next week that they can perhaps trim a little bit at the long end of the curve because there's greater term premium there. Mm-hmm. But for the Fed, it is. I think we were all hopeful that as we got through the summer months, that everything was trending in the right direction. The labor market was moving into better balance. Growth was clearly slowing. Inflation, core PCE inflation was 2.2%, 3-month annualized change.
Yeah.
I think we all got very hopeful that we could get all the way back down to 2%. I think the uncomfortable part for the Fed, and where I think there is greater risk here, is that you can make a lot of progress getting down to 3.5% on inflation, but that perhaps that's where the progress stalls out, and maybe you need a weaker labor market to get all the way.
If you are just joining the program, we are seeing a bit of a lift to markets with the S&P up about 0.6%. Matt, to pick up that point, though, you do have this concern about wages and how they play into this. And we talked to the CFO of General Motors. Are you seeing that as the sign of a peak in terms of labor market power, or as a sign of more to come?
My take is that it's a sign of a peak. I think when you look at the broad macro data that we have in the U.S. economy, you see that people are quitting their jobs at a much lower rate than they were last year, 18 months ago. When you look at wage expectations from small businesses, they've mostly normalized. And so I think the macro backdrop is one in which labor demand has come down, job openings have come down, The unemployment rate has picked up a bit. Labor supply has actually picked up a good amount. And that has led to better balance within the labor market. Sure, you definitely still have these pockets that are taking place, particularly in highly unionized areas, where we are going to get wage increases, probably spilling over into price increases. But broadly speaking, I think the labor market is showing evidence of coming into better balance.
It seems like that's been the feeling among a lot of people, although then I get reports saying that there's quits are actually coming down. Did you get some of these messages? And that necessarily, if you look at the WARN notices, I mean, these are the types of data that people are now pointing to for signs of softening, which gives you a sense of how unreliable the major data points really are. Coming up, we do get that major data point at 9:45 a.m. of some of the PMIs in the U.S. Also coming up on the open next hour, Bob Elliott of Unlimited Funds, Andrew Sliman of Morgan Stanley, Mandy Zhu of SIBO Bats, and Colin Sebastian of Baird to parse through whether we can actually say, yes, we are moving to earnings and focusing on that rather than yields. From a beautiful good morning in New York.
This is a big week because historically, this is the week, the third week of earnings season tends to be where you start to see those earnings expectations start to move higher. If that does not happen this week, I think we're going to be challenged to get that year-end rally going forward.
It's all down to this earnings season. Larry Adam, their Chief Investment Officer at Raymond James. Lisa's absconded. You'll see her very shortly. They've left me in charge. This could get tricky for 15 minutes. Joining me now is Mandeep Singh, Senior Tech Analyst for Bloomberg Intelligence. It's a relief to see me rather than the other three, isn't it? Aha! Okay, so we're going to get a few more tech results. Part of the Magnificent Seven are going to get delivered today. Talk to me about Google, owner of Alphabet, Google, whatever way round you like to look at it. Are they more immune just simply because I've got to advertise on the platform relative, let's say, Meta or to Snap? I mean, that's the consensus in the story. Do you believe that?
Yes, and also the divergence in expectations. So Meta is expected to grow 21%, Google 10%. And when you parse through their business segments, you know, the search will likely be resilient. We know they're not losing any share to OpenAI and Bing and YouTube. I mean, that 10% is a low bogey. So you probably should expect some upside there. Cloud, another big segment for them. And I mean,
we really used to get very obsessed. Well, not used to get very obsessed, but we are absolutely obsessed. What happens in cloud at Amazon? What happens in cloud with Alphabet? How has that grown, and where can that get to, and how important is it?
Yeah, so think of the three hyperscalers, Amazon, Microsoft, and Google. That makes up about $180 billion in cloud revenue, and they were growing at north of 30%. This year, the growth has decelerated to about 18 to 20%. So what everyone is looking for, that acceleration next year, because these are the companies that are buying all the NVIDIA GPUs. And if that doesn't translate into real revenue, then we got a problem. But so far, the story has been that hyperscalers will provide the GPU capacity for generative AI, and that's going to reflect in 2024 numbers.
And those hyperscalers are also critically important to Amazon as well, aren't they? And Amazon's going to be a lovely insight into how strong we are or not on the consumer side as well.
Yeah, so Amazon is the largest player in the public cloud, the $180 billion revenue that I mentioned. It's about 45%. Microsoft is the second big player. And in the case of Amazon, everyone is thinking they are behind in that generative AI race, and the other two are ahead. But clearly, you know, they are the largest player in cloud. And if anything, this generative AI wave is going to accelerate that shift to cloud, because you can only do AI training on the cloud. You can't do it on-prem.
Are you going to be on AI word count in this reporting season in the Magnificent Seven? I mean, it's all you got to do is print those two letters and you're off to the races.
Well, now I think the time has come to guide
to 20... Are we going to be more discerning?
And the 2024 guide is very important. So that's where you are going to see companies that actually guide to that lift from GPU revenue on the cloud. That's where you're going to see, you know, the multiples and the estimates go up. But so far, it's been a huge investment year. Everyone is hoping 2024 is when it translates into revenue.
And then if I talk about Microsoft is interesting for all of the aspects that we've just touched on, a little bit of AI, a great deal of cloud, but also for them, there's the hardware side of this as well. Where does Microsoft fit into the Magnificent Seven?
Well, Microsoft clearly had that early OpenAI partnership, and that helped them, in terms of establishing that generative AI leadership. But I think the PC side is still weak, and you are seeing that decline in that Windows revenue. Clearly, that hasn't changed. Everyone is calling for a PC bottom this quarter, but we don't know if that's going to be the case. And in the
if we slow down next year, it could be that Microsoft takes the bigger hit, perhaps out of this grouping.
Well, so Microsoft has a lot of application software revenue, and if they don't, add those co-pilots to really complement that, and if there's actually real disruption from generative AI, I would argue Microsoft is at risk. But nobody doubts that Office, will continue to be strong because they added these co-pilots, and that will be a nice add-on to, what you already have from the Office suite.
So Europe is under pressure. Technically, we can argue about recession. China, you can debate whether they're going to make 5% growth or not, but it's tough in China at the moment. With those two global markets very much under pressure, who is perhaps the weakest link in the Magnificent Seven, vicariously exposed to the China story?
I mean, I would say Apple. No doubt about it.
I'm just about to buy a new Apple 15.
From a revenue perspective, 20% revenue, and the supply chain exposure is huge. So if there is a big risk that clearly lies with Apple, the other ones are somewhat insulated because they don't have a lot of revenue exposure. And that's where the internet names like Alphabet and Meta, they have no exposure at all. So clearly Apple is the one to watch out for in terms of that geo revenue exposure.
Okay, and then of course we have the friendshoring, onshoring. Let's see what the numbers are when they drop. Thank you so much for stopping by. That is Mandeep Singh on all things technology. Let's continue the conversation. We have Matt Luzetti from Deutsche Bank rounding out this 3 hours. We've sort of covered the globe, but it's interesting when we talk about tech. Don't worry, I'm not going back to your reports as to whether you're using generative AI to deliver them. But what I did want to pick up on is the China conversation. We are so very centric here in the United States and in Europe and the UK. It's amazing when you drop into different geographies how perhaps more myopic we become. Have we spent enough time in the past 3 hours talking about China and the risks?
Yeah, I think certainly it is a big driver of the U.S. global economy. I think it's less so tends to be a driver of the U.S. economy. When we typically think about the beta from China growth to U.S. growth, it's about 0.2, 20%. So if China growth falls by 1%.
So it's an international obsession, not harbored by the States.
I think it's when you look at the U.S. economy, it's 70% consumer.
Yep.
It is very much domestically oriented. And I think particularly in the current environment where services is a big driver of it. That said, we've had several Fed speakers over the past several weeks highlight the global economy as a key risk factor for the U.S. economy. I would lean a little bit more towards the potential lagged effects of monetary policy kicking in, the tightening of bank lending conditions, the tightening of financial conditions as being key drivers for risks out there to the downside. But no doubt, Fed officials are taking notice.
It's staggering, isn't it? Mortgage rates at 8%. Buying your new car is going to cost you an awful lot more this time around. To what extent does the 8% on the mortgage rate really begin to kick in? There's a stagnation in terms of sales and properties for sales. I understand that. A lot of people are already long their property in this country at 2.5 in the past 10 years. When does it matter that we have mortgage rates at 8%? Is that a very long variable lag? Can that be as injurious as it was in previous cycles?
It's a very long and variable lag at the moment. I think you're right that it has impacted housing activity. We see mortgage purchase applications that are the lowest since 1995. We see existing home sales that are collapsing. But at the same time, the household balance sheet is mostly insulated from this effect. And it is because people have locked in 30-year fixed mortgage rates at 3%. Now, it does have knock-on effects to other parts of the economy. Because of that, people aren't willing to sell their homes. There's a lack of housing supply. You may have job openings in different geographies that people won't move to. And so it leads to this mismatch within the labor market. So there are knock-on effects. There is an impact. But the key channel of transmission onto the household balance sheet just is not as powerful as I think it typically would be.
And in terms of the actual, they'll keep going until they break something. That's a narrative that seems to come through. The Fed are trying to tell us they're going to proceed carefully. Jamie Dimon doesn't care whether it's another 25 bips or not. He's not bothered about that. Is he right not to be bothered? Because at the margin, I'm not a PhD economist, But at the margin, 25 basis points is not going to make or break, fill or kill this economy, is it?
Agreed. I think if the debate that we are having in several months is just does the Fed go one more time or not, then that's a good outcome for the economy. I think it's a good outcome for soft landing prospects, and it does not have a material impact on the economic outlook. Where I think the risks lie, though, are that several months down the road, we do see some uplift in inflation. The economy has not slowed.
That's the biggest risk of all, isn't it? Whether there's a second coming of that brutality of inflation.
That not to the extent that we saw last year,
no.
but some uplift to a level that is uncomfortable for the Fed, particularly if you have a backdrop of strong growth. And then I think the debate for the Fed is not just do they go one time or not. It's a debate about how much further might they have to go. Now, the bond market's doing a lot of work for the Fed right now, so the market is not kind of bringing forward some of these risks. But 3 months down the road, I do think that that's a risk that we could really see.
Okay, Matt, a very full and plentiful plate to choose from. That is Matt Luzetti there, Deutsche Bank. Our guest this morning, rounding out the hour. They've left me alone. Tom and John are on a cruise somewhere. I have it on good authority. There was a red headline earlier on. Lisa Abramowicz couldn't take much more, so she left me to give you a final market wrap for this Tuesday. There you go. You have a small bid to equities. Why is it not stronger on the drop in yields? But yields are just drifting along after a brutal day yesterday. Good morning from New York. Up next,